First of all, it means that the yield curve is normalizing up, not down to 3%. And that means that we could have higher rates for longer at a time where this economy can keep chugging along despite rates where they are. Can the credit markets sustain a 5% or 4.5% long-term base Treasury yield? Does that wreck some of the math behind the credit bet?
Well, yes and no. So, I mean, I think the economy can handle higher interest rates. I think that has been the mistake that many investors have made, myself included, the underlying strength in the economy and the ability to handle higher rates and the benefit of higher rates that you're seeing vis-a-vis the consumer. But you're quite right, Lisa. There's been so many capital structures, whether it's in commercial real estate, whether it's in credit, that have been built on the backs of extremely low interest rates. So as interest rates remain at the higher level here, then a lot of those capital structures really can't withstand that environment. So as a consequence, I think we're in this stronger growth environment. But at the same time, we will see above trend default and distress activity as a lot of these companies really just are unable to be a going concern with a higher rate environment.
One thing we keep hearing, Craig, is a number of investors say they're leaning into duration because you might as well lock in yields where they are. Getting 4.2% for 10 years looks pretty good relative to what you used to be able to get. Are you saying that there is more normalization to be had if we are going to create a more flat or more normalized yield curve?
Yes, and that's what we've been saying, and I've been arguing that for the past 6 months, as I think it's too early to lock in duration. If you believe that the economy, is entering a soft landing, no landing, whatever landing you want to assign to it, that means rates have to move higher, not lower. And so, yeah, the Fed might modulate a little on the margin, take rates down, but not as much as in the price, right? And so for me, rates are higher. I don't see any rush to lock in duration at this point. We're leaning against that and have been leaning against that for quite some time. So we're still short duration as once again, it's growth, Lisa.
I assume you're taking that position, Greg, not because you think we're going 10, 20 basis points higher than where we are. It must be bigger than that. What kind of numbers are you thinking we can get to?
I don't know. There's been a big move already, right? So I don't want to get greedy either. But I think on balance, the tendency will be for higher rates, not lower rates. And so, we've been kind of talking about this range of, 4 to 4.5. But the truth of the matter is it's leaning against the forwards and what's in the price. And what's in the price in the forward space, continued rate cuts, and a lower yield environment. So that's kind of what we're leaning against more than kind of making a call on where rates ultimately settle out. But it's the tendency for rates to be higher that I think most investors are missing. As the regime that we were in pre-pandemic is gone. It's different. And I think the rate regime is different as a consequence. And I don't think investors have accepted that reality or accepted the reality that the Fed also can't easily and readily cut interest rates like they did in the past.
So, Greg, what I hear then is just another way of saying don't worry about the reinvestment risk of sitting at the front end. Is that right?
Yeah, to a degree. I think cash rates are really quite attractive here. I think that's inducing investors to take risk off the table, not lean into it. On the credit side of the aisle, there's tremendous opportunity across the global credit markets. A lot of that opportunity, though, is in safe type of allocation. So whether it's front end type of credit, whether it's structured products, these are safe bets where you earn a tremendous amount of carry. You don't have to dip down into triple C's, take a lot of duration or credit risk. And so take what the markets are giving you, and what the market is giving you is really quite attractive here. So we're extremely bullish on the U.S. economy. Kind of on a long-term basis. We're very bullish on fixed income as well, but you don't have to take a lot of risk in order to be successful. And I think that's the important message that I want to leave with.
Message received. A clinic. Greg, thank you, sir. Greg Peters there of PGIM Fixed Income. If you are just joining us this morning, good morning and welcome. Your S&P 500 is positive here by just 0.02%. 2%. We'll turn to retail in just a moment. We'll catch up with Dana Towsey. Looking forward to catching up with her. Carl Riccadonna of BNP Paribas joining us at 8:30 Eastern time, so about 48 minutes from now. Lisa, we've heard that from a few guests, you know. BlackRock's Rick Reeder has made the same point that Greg Peters just made. Those conversations, more and more people having them right now. They've listened to their advisors. They've bought the front end. Cash isn't trash anymore, just to reverse the kind of thing we used to hear from Ray Dalio. I think he himself has said that over the last few months. And now they're trying to work out whether they should go further out along the curve and lock this in, because people are starting to discuss rate cuts. Greg Peters taking the other side of that in a pretty emphatic way just then.
And basically implying that the market is coming around to his view. And there are a growing number of people who clearly are thinking in a similar way that he is, that maybe this isn't going away so quickly. We were talking about this earlier in the week. If everyone's going long duration, why aren't yields going down? If everyone's saying this is an opportunity to buy, why aren't we seeing that in the price action? And that really does raise the question that more people are getting on board with higher rates for a lot longer.
Well, lots of people seem to be buying Target this morning. The stock is up by 7.7%. We'll be talking about that in just a moment. Dana Towsey of Towsey Advisory Group on retail earnings this week. Home Depot yesterday, Target and TJX this morning, Walmart coming up tomorrow. A wrap of all of that up next from New York. Good morning.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
Right now, inflation is coming down. We've made some progress, some good progress. I feel good about that. It's still too high. The good news is the labor market has remained very strong, but it's a little bit of a double-edged sword. Are we done raising rates? I'm not ready to say that we're done. In terms of cutting rates, I think we're a long way away from cutting rates because core inflation is still around 4%. It's still around twice of what our target is.
Neil Kashkari there of the Minneapolis Fed speaking in the last 24 hours or so. I'm tempted not to say this because I don't want to jinx it, but the England women's team in the World Cup at a semi-final, 3-1 up against the Australians, minutes away from completing that semi-final and going ahead to the final to play Spain later this weekend.
Yeah, I expect that half of our audience actually right now is watching that game instead.
Just wanted to squeeze that in.
So if you're not, this is it.
We're in the 90th minute and it's 3-1, so we'll see.
You could wait to the 90th minute.
I'm not watching it. I'm just looking at the scores.
I'm
doing my job.
You're not doing a full TK?
No, TK actually watches video. I don't watch video.
You have standards.
I have standards. I'm just watching the live score on livescore.com. Dana Towsey joins us now, CEO and Chief Research Officer at Towsey Advisory Group. Dana, great to have you with us on the program. Target, I guess, beating a low bar because the stock is rallying really hard. Can you tell me just what's going on there? How low was that bar and how much clarity have you got on what's going on over there?
We'll have more clarity after they do the earnings call at 8 o'clock, but I think the real change is the fact that the inventory levels continue to remain very clean. When you take a look at the gross margin, it was better than expected. Shrink continues to be an issue out there, but it's all about essentials, which is frankly much stronger than what you have with discretionary at Target. And it's a world of difference because you had TJX just report better than expected numbers, talking about the strength in apparel and accessories. So if you have essentials, that's what's selling, but off price is where the action is for apparel.
Dana, before we get into TJX and exactly what the retail trends are, I'd love your thoughts on what we're hearing more of, which is the social pushback and the consequence on sales. If you look at Target's earnings, they said that last quarter's profits took a hit as a result of the controversy around Pride Month collections of items that they were selling. Dana, we also heard this from Anheuser-Busch. How much is this becoming a theme? How much is this a real potential threat for retailers that hadn't dealt with this kind of thing as much before?
It is a threat, and we've seen it happen to multiple different categories of companies selling consumer goods. Certainly, I think the care and the concern about how you navigate this landscape is something that is new for all the retailers, and I think is only going to continue to become more of a topic going forward. And I think you're going to see these consumer companies even more mindful and planning about what stance they take on particular issues.
Going forward, when you talk about the off-price retailers really benefiting at a time where people are being more discretionary, is that a negative sign for the luxury players, or is it just there's plenty of money to go around?
I think overall, the luxury players are in a world of their own. They have a high-end consumer who has less susceptance to really being careful about their spend. But there's different magnitudes of certainly luxury and aspirational goods, depending upon the price point. The comparisons year over year are very challenging in luxury. And while many of them, even the European luxury goods companies, are lower year over year, when you compare it to 2019, they continue to be up, could be 50% or more. But I think every level of consumer spend overall, we've seen a moderation. And where we're seeing the allocation, it seems like one of the only places in discretionary. If it's any of the events like Taylor Swift or Barbie, that people are buying new costumes or new items to wear to those events.
Dana, just to touch on luxury a little bit more, different regions are performing better than others. In America, it's been disappointing. I'm thinking of Richemont and others too. Dana, recently China have allowed group tours to, I think, the UK and the United States. Some people believe that might make a difference. I want your opinion on that. Based on experience over the last year, does that move the dial?
I think it's going to help. I think it's going to help. I think it's going to help show an increase. I think it's going to help to drive demand. I think you need more than just the tourist groups to truly move the needle, but it should help stem the rate of decline that we've seen from some of those luxury players in the Americas.
A theme I've tried to work on over the last year, and I have to say I haven't had much clarity on it, Dana, but maybe you can help me. 2 years ago, we would see a lot of people embracing buy now, pay later for entry-level luxury goods. What we've learned in the last month or so is that entry-level luxury at certain firms has been hit. Are the two things, in any way, shape or form, tied? Do those dots join up to you, Dana? Have we seen that buy now, pay later bubble burst for luxury?
I think that it has burst certainly a bit for luxury. I think when you think about the headwinds of rising interest rates, you have student loans that are coming up in October. The average household has $6,200 of expenses, and you're going to get an increase of 3 to 8% of spend coming from student loans on top of that. There's less to go around. And so that's why there's the focus on essentials and a reduced focus on some of the aspirational items.
Dana, just to build on what John was asking about, are you surprised that we haven't seen more of a hit to luxury retailers on the 1-2 punch of certain entry-level buyers stepping away and some issues with China, whether it's restrictions or whether it's the idea of just the contraction that we're seeing in certain aspects of the economy, why that hasn't had more of an effect?
I think some of the aspirational players that are out there, they've added a lot of newness and product innovation. There's extreme demand for newness and innovation, and it's really led to be able to have continued strength. But it's not a world of equals, it's definitely a world where essentially, what's the price you're charging? There's some promotions on some of these items that people can get, and what are you seeing others wearing? What are you going to give up in order to buy that aspirational item? And I think it's definitely haves and have-nots in terms of being choiceful in what spend is on.
So what happens to all of the middle players, the middle tier that don't fall into bargain picking or luxury?
Well, look what we've seen. We've seen it be very challenging out there. We've seen it for apparel retailers like the Gaps of the world. It was encouraging to hear American Eagle the other week talk about the pickup in July. We've seen retailers overall lower their inventory levels, but I think you're going to see these inventory levels continue to come clean because the lower freight costs being a help to the margins, the leaner inventory levels, there's more margin clarity. I think the cleanliness on inventory will be the key to managing through this because you have to keep your balance sheet sound.
Dana, I have no idea how you listen to the call and conduct an interview at the same time, but you can. It's amazing. Dana, thank you. Dana Towsey there at Towsey Advisory Group. We appreciate it. I wish TK was here to tell us all about Stealth Wealth. You'd have to imagine Stealth Wealth is going to absolutely hammer some of these luxury firms, and I'll tell you why. People go to Gucci because they want everyone to know they've just bought Gucci. You go to Brunello, Loro Piana, with no branding on the clothes. You go there because you know the clothes are good and it's a high-quality material. What's Gucci and everyone else going to do now when their value offer was basically the brand across the hoodie or the brand across the T-shirt or the logo all over the handbag? What do they do now?
I'm going to take this a step further. Are you saying that it cheapens their brand because it appeals to a certain aspirational player and then all of a sudden everybody goes more to Stealth Wealth?
I'm saying that they're going to have great difficulty finding a better value offering when their value offering was just a brand, a logo.
Yeah, well, I think that you're seeing that with certain, I mean, Celine, have you seen the price drops on some of the Celine items?
I haven't seen it. They gone down if they cut prices.
I've seen some, yes, on the margins. So you start to wonder at what point is that sort of what people are pointing to. That said, the dispersion that you're seeing, at what point does that become something more broad-based versus just ongoing, disparation of the economy, right? I mean, the idea that you've got the haves and the have-nots has been an age-old story. At what point does that really feed into the headline figures?
I thought the quiet luxury theme would kick in earlier coming out of the pandemic, that it would be a little bit more modesty after the hardship of a lot of people. But then I guess everyone got sent checks and everyone just went nuts. It was the opposite.
Oh, no, it was the opposite.
I got that so wrong.
Really? Well,
I got that so wrong.
Oh, I think that everybody was ready
longer.
to celebrate. I think that what Dana Towsey said about people dressing up to go see Barbie, if you go see Barbie, theoretically, you can see all of these people wearing, pink outfits and huge dresses and everything that they clearly just went out and bought because you don't just have a shade of pink.
Dress up for the movies.
100%. You see everybody doing that.
When I watch that at home, would you like me to dress up?
100%. And please send me a video.
I'll wear an Inter Miami football kit with Messi on the back.
Which has the same color.
Represent.
I'm just saying, people want to have events. They want to live. They want to get out there.
Yes,
the Roaring
they should.
20s.
They should. Is that what this is? Didn't turn out that way, did it? People thought it would be. Do you remember that? The Roaring 20s.
Well, maybe it is. Maybe that's what we're seeing.
It might be. We'll see, won't we? Full time, 3-1. The England women's football team beating Australia 3-1, going on to the final later on this weekend.
Welcome back to another special Western and Southern Open update for Bloomberg TV and Radio from Tennis Channel. I'm Erin Coscarelli. World number 1 Carlos Alcaraz returned to his winning ways in Cincinnati after he took out Australia's Jordan Thompson. The Wimbledon champion went out early in Canada last week and will be looking to tune up his hard-court game ahead of the U.S. Open. And don't forget, you can watch all the action live at 11 a.m. Eastern on Tennis Channel. I'm Erin Coscarelli.
New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So $1 there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute, and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Six months from now, if rates are still 5+%, we're going to be having a much different conversation than we are now.
We are not certain that the last hike is behind us.
The Fed will have to be more aggressive, raising rates higher and keeping rates higher for longer.
The Fed's not cutting rates until March next year.
A soft landing is like putting a thread into the needle, and the eye of that needle is shrinking.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market totally unchanged on the S&P 500. The retail players this morning, anything but unchanged. The likes of TJ Maxx out earlier this morning with some earnings. We've heard from Target as well. Target's a curious one. A miss on the top line, a beat on the bottom line, a cut to the outlook. Check out the stock. The stock off the back of this, Bramo, flying through most of this morning.
But how much of, again, is this just where expectations were? And again, they were the ones that really were slammed earlier this year, even as others did well. And so at what point is this a comeback trade? Because it wasn't terrible. And they actually did eke out a surprise in terms of profitability in the quarter.
It's on to Walmart tomorrow after a series of upside surprises dominated by what we got from retail sales just yesterday, this time yesterday, which sparked and brought back to life that conversation about maybe, cough, I'm going to say it quietly, no landing?
Yeah.
No landing? Are we having that conversation again?
That's what Greg Peters basically said. And what does a no landing mean for yields? It means that they're going to normalize up, not normalize down, the way some people were calling to 3%, say, across the yield curve. There is a question here about how to read the nuances, whether we can read in that this isn't going to be a no landing, this is going to be something that does have to ultimately come down with some sort of pain. At the same time, it seems like that's what the data is screaming.
This is why it matters to people. We're going to next week. Jackson Hole going to hear from a load of Fed speakers going into September 20th. People want to know if that rate cutting cycle is going to begin next year and whether they should lock in their cash savings to longer dated bonds. Lock in those high yields while they're here. I've heard that argument from Lisa Shatter at Morgan Stanley. The pushback from Greg Peters in the last hour is basically saying, don't worry about it. People are underestimating how long rates are going to stay this high, and that if you are in the front end, you can pick up 5%, no problem, and not worry about the reinvestment risk down the road. That's a really important debate for a lot of people away from fixed income. Forget all the bond market jargon. If you're at home, you have this big pool of savings, you're getting 5% on it. Are you worried that 5% disappears a year from now?
And we're hearing a real split in terms of people who say that they're going in, and yet yields have continued to climb higher. I wonder whether the Fed is losing its relevance, because even if they come out and they say they're going to cut rates, they say they're data dependent. At what point do you just see inflation expectations go up? We saw that over the longer term. In other words, the more dovish they get, does that just create a more upward tilt to longer term yields if you believe the growth is there, if you believe the momentum can continue?
That's the danger of embracing the rate cutting story too prematurely, too early. When you start to talk about disinflationary trends, meaning real rates push higher and you don't want things to tighten, then you have to reduce the nominal rate. I get it. It makes sense. I understand why you might want to talk about it. But whenever you bring up that conversation, you are sending a signal. And I think that's what you're getting at.
Well, and just to sort of push this to where we're going to see in 30 minutes, we're going to get housing starts and building permits. And that's been an area of incredible strength at a time where the mortgage rate's the highest going back to 2000, 2001. So at what point can you say, okay, this deceleration is enough to bring down inflation if you still see housing prices going up, despite rates being so high relative to the recent history? Again, this goes to the conundrum that I want to hear from Federal Reserve officials, because do they worry about erring on the side of not being hard enough in terms of creating a little bit more pain?
That housing market's dying. I mean, it's just seizing up. Can you imagine working in real estate right now on the residential side of things? It must be brutal.
Well,
it must be absolutely brutal.
You've seen the layoffs in terms of mortgage brokers.
It wants a mortgage of 7-8%. Who wants that?
Yeah,
Who
well,
can
they're not
afford
getting
that?
it. Although I do wonder if the new mortgage broker is at the home builder, because they're extending mortgages that are a lot lower because they have the capital and it's a lot easier to move inventory.
That's where the boom is, that's for sure. Equities right now on the S&P 500, just about unchanged. It's been a bumpy road through the month of August. We're positive here by 0.06%. In the bond market, yields a little bit lower by a couple of basis points, 419.14 on a 10-year. Joe Quinlan joins us now, CIO of Market Strategy at Maryland Bank of America Private Bank. Joe, wonderful to have you back with us. It's been a while, sir. A bump in the road in the equity market. Is that a bump in the road you and the team want to buy?
We do, John, but selectively, because we think there's more bumps coming through September and October. But we want to be positioned for the recovery. You were talking about the recession. I think next year we talk about the economic recovery. So, yes, we're selectively on a qualitative basis buying the dips, but we think there's more volatility ahead, near term.
With all due respect, recovery from what, Joe?
Well, we're moving, the narrative is going to shift from recession to the fact that no landing, and we're going to see growth, I think, pick up in the second half of next year. We're not there yet. We've got to see the goods manufacturing pick up. You just talked about the housing problem. So I think we're going to shift the narrative, like the U.S. picking up steam into this, say, Q2, Q3 of next year, and the recession talk starts to fade.
Is the recovery trade different when you have rates north of 4.5%? In other words, do higher yields in the face of inflation that may remain higher than it has been for numbers of decades going to challenge the traditional thesis of buy the most cyclical stocks?
That will be a challenge, Lisa, for sure. But remember, right now, money market funds sitting there about $5.5 trillion. The average since 1990 is around $2.5 trillion. So there's a lot of dry powder out there for equities and for fixed income, in our opinion. So you're going to start to see that rotation. But we clearly have to see the Fed cut rates, the eyes in recovery when it comes to the recovery. And that's, I think, sets the stage for like more of this liquidity, short-term cash to come back into equities.
Joe, I'm thinking out loud here, so work with me. Someone's got to pay the price for the pandemic. People talk about how strong balance sheets are of consumers. People talk about how strong corporate balance sheets are as well. Someone subsidized a good chunk of that, and that someone was fiscal authorities. Treasury has got to issue a lot more supply. Now, are we starting to see the Treasury market pay the price for that over the last month? Because what's curious for a lot of people, you've had this backup in yields on a 10-year, but credit spreads have stayed really, really tight. And the reason people give for that is that they've been able to go out and refinance, lock in low rates, for longer. Treasury didn't do that. Now, I'm wondering how weak this sovereign is on the supply side of things, Joe, and whether the risk this time, the individual, the group of investors that have to pay the price for the largesse of the last couple of years are in the Treasury market.
We're going to see some of that, John, play out, but I do think now you got to widen the global lens a little bit here. Look at the deflation in China. Look at the U.S. outperformance relative to the rest of the world. So I do think there's going to be underlying demand, foreign demand for our Treasury, for our paper. Albeit, having said that, yes, our interest payments on our debt continue to rise. There's talk about our credit rating. That's going to weigh on the market sentiment as well. But I do think at the end of the day, you're right. We're going to have to pay the price. You're already paying it in terms of higher interest payments. And a lot of that flows overseas. But I think at the end of the day, on a relative and an absolute basis, you still want to own U.S. paper right now and into next year. And that takes us to the funding cycle.
I want to pick up on something you were saying, and it's related, the idea of yields that come down next year as the Fed cuts rates. How do we get both a recovery trade and the Fed, who sees the reason to cut rates, even though there isn't a great degree of weakness?
Well, Lisa, I think it's going to come down to earnings. Earnings are going to have to really accelerate. We're looking around 8. Savita, my colleague, is looking for around 8% earnings growth next year. If we get anything above that, then we can push higher with the equities. So you can have the Fed cutting rates. That sets the stage for the rebound for the U.S. And then overlay that with, I just think, kind of the dynamic nature of the economy. You look at the infrastructure spending, the green revolution, energy, you name it. There's going to be places to put money to work, even with the Fed cutting rates, and we'll work through the cycle.
What rate, terminal rate structure are you looking at that keeps you bullish in stocks? In other words, how high could rates go before you start to get concerned that maybe there's a different thesis this time around for stock valuation?
Well, the good news is we're near the end of the Fed tightening cycle. Our colleagues, our economists are looking for one more rate hike in November, and then we kind of level off here. I think, Lisa, the key is here. It's this. How long do we stay at these terminal rates? Is it 5% plus? I mean, that's going to be the issue. I don't think we're going to come down very dramatically. So the longer we stay at 5% plus on the Fed funds rate, the more stress that builds out there and more questions that we have to work through. Doesn't mean we can't work through it, but we do see, the longer we stay at these elevated levels, the risk remain that we have to be cautious.
Hey, Joe, thanks for being with us for the update. Joe Quinnen there of Maryland Bank of America Private Bank on the latest. This is the latest from Citi. The latest from Citi. Here's the line from Andrew Honhorst and the whole of the team on the economic side of things in the research division. Yesterday's solid retail sales reading for July shows spending growth not only holding up, but broadening away from service consumption. FOMC minutes out today. 2 p.m. Eastern time, by the way, may mention the possibility that a sustained expansion will imply a longer period of higher policy rates. All of this, Bramo, into Jackson Hole next week.
And it's sort of what we're seeing priced into the market a little bit. Resilience is this line that a lot of people are pushing back a little bit on. Is this resilience or reacceleration at a time where you had asked, are we going to see services go down to goods or goods go up to services? Andrew Hollenhorst coming out basically saying we're seeing goods go up to services, not the other way around in terms of how much spending there is.
Neil Dutta just on point. I think I bring up Neil every single day at the moment.
He got it right.
The world's just coming his way. I've got no idea who will be right ultimately, but just the conversation is shifting towards him again.
And he talked a lot about home builder sentiment. He talked a lot about the revival in certain goods sectors that had gotten beaten up. The sort of rolling recession shows that the underlying theme is strength. And that is what is perhaps, to Greg Peters' point, keeping yields elevated on the long end.
As far as I know from what I've seen, I don't think we've had a confirmation that Chairman Powell speaks next week, though most people assume he will.
You're still on this. You're still trying to push this narrative, this
conspiracy
theory.
I think a lot of people want to hear from him. There's no conspiracy theory whatsoever. I just think from my perspective, I expect him to be there. I expect him to speak. I just think he's got enough data left between now and September 20th just to wait and not really say much at all.
If he confirms that rates can stay higher for longer, it's what he's been saying all along. It just has more resonance this time around, maybe. So you might see a market reaction to something that has always been the status quo on the Fed for the past couple of months, and yet this time seems believable to markets.
If you feel like you're in an inflection point for policy, it could go one way or the other. Is that the right time to double down on any message, whatever that message might be?
What if they're not at an inflection point? What if they're just like, you know, we're just going to hang out here?
Truly data dependent?
Yeah.
Live meeting?
What does that mean,
month
though?
after month?
I mean, I want to dig into what that actually means.
I'd like an explanation of that.
Yeah, me too.
How are they dependent on that data?
Which data?
It's just such a throwaway line,
Is it back,
isn't it?
or is it looking forward?
We're data dependent.
Yeah, I know.
Yeah, like kinda. Okay. If you're just tuning in, welcome. The S&P 500 totally unchanged here, positive by 0.03%. Coming up, 8:30, watch out for this one. Carl Riccadonna of BNP Paribas following the US housing data. Lisa's going to break that down for you and then get Carl's view on the world and the US economy. Then shortly, up next, Nikolai Tangen of the Norwegian Wealth Management Group. Lisa, this one's going to be fascinating a little bit later.
They account for some incredible proportion of global shares, and they've been incredibly active with a lot of boards because they have to own the index, right? I mean, they basically are certain stock markets. So to hear how they're trying to maneuver will be interesting at a time when you kind of can't avoid a market that is tied to the global economy.
If you're running a sovereign wealth fund like this individual is, and he's said this before, your real challenge is not what you own, it's what you don't own. That's what you've got to get really specific about. And back in the spring, he talked about the bad apples. We need to be very careful about the bad apples coming out of the SVB failure. I want to understand what bad apples were there. What did he have to back away from? Then we can get into the weeds around where they are cross-asset right now. I'd also like to know, the BOJ owns a lot of Japanese bonds. They own Japanese bonds too. I want to understand from someone who owns Japanese bonds, why are you holding Japanese debt? What is the reason you would hold that fixed income, that security? Why?
And when they have to trade them, do they call up, you know, Chairman Ueda and say, hey, do you want some bonds? Because we could sell them to you. Just give us the price because you're going to do it anyway.
That's the flavor of the conversation coming up next from New York City. This is Bloomberg.
This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The issue we're having now is, frankly, expectations. You know, if you look at what's happened over the last month, you had a reasonably solid earnings season, but the average stock that beat EPS was unchanged on the day. You had, you know, a solid payrolls report, the market traded off. You had an easy inflation print, the market was flat. So, yeah, I mean, there's a lot of good news out there, but the market, I think, has become a little callous to it, which is kind of not good for risk reward in our view.
That was Stuart Kaiser of Citi. Great to catch up with him in the last 60 minutes or so. Your equity market more broadly looks like this morning on the S&P 500. futures have been unchanged. Bit of a snooze, a welcome snooze after the events of August so far, if you are long the Nasdaq, because the Nasdaq has been a difficult one through August. If you've been long all year, congratulations, well done. You won 2023 so far. In the bond market, yields are lower by a single basis point, 419.93, just going against the grain of the last 4 days or so. We've had 4 straight days, Lisa, of yields climbing.
And a real reset here. You called it what, the no landing? I think soft landing is what people prefer because no landing is.
We went from
definitely
soft to no to hard.
Yeah, exactly.
To soft again.
All we can say is that people are gaming out what it looks like if you have growth that is sustained at the levels that we've seen.
Can we sustain this growth? Norway's $1.4 trillion sovereign wealth fund returning 10% in the first half. That's some better performance, Lisa, after the year before.
Yeah, it's a resurgence after having a pretty brutal year last year. This fund is something that has to own a lot of the broad equity performance. The key is where they adjust and what on the peripheries they invest in as well, whether it's real estate, whether it's some of the more alternatives as well.
Let's get to that now. I'm pleased to say the CEO of that fund joins us, Nikolai Tangen. Nikolai, wonderful to catch up with you, sir. It's always great to get this catch up every other quarter or so. You talked more recently in the last 3 months or so about the bad apples following the collapse of SVB. How many bad apples did you find in the last quarter?
Well, we are continuously trying to find them. And earlier in the year, we were out of Adani Group in India. We have been out of a big Swedish property company, which went bad. We have a whole team who's trying to navigate this and make sure we are out of the biggest trouble.
In the latest quarter, you did get a 10% return, although you dragged down just a bit from certain real estate investments and certain renewable energy infrastructure assets. How do you view your investments, particularly with renewable energy infrastructure at a time where there seems to be a shift away from that a little bit and towards oil and gas?
Yeah, we got it into our mandate a few years ago, and we were very slow in the beginning because we thought prices were too high. There were too few projects, and everybody were chasing the same project. So we went really slow. I think it's more attractive now. I think the returns you can make in this sector now is better than it was. So I think you should expect our pace to increase a bit.
What about real estate? How concerned are you? There are a lot of people raising concerns that we haven't seen the true reckoning yet, particularly in commercial real estate. Have you been selling? Have you been trying to shift away from that?
No, we've not been selling. We have been staying put. We have just continued to own what we had. I think we have seen a lot of the damage in this area now. We've had rates increasing already. We have seen high vacancy rates. We've seen the whole COVID effect. We've seen the banks having troubles. And so I suspect that we may have seen a lot of the bad news now.
So you think, in other words,
we also have big exposure in the logistics side, and that those investments continue to perform really well.
You said that you think that a lot of the carnage has already happened. Can you elaborate on that at a time where people say that if the true mortgage rate were really percolated into valuations, you would see some 30% declines, in some capacities more? You think that that has already been either priced in or shrugged off because of strength?
I'm not sure all is priced in, but we for sure have taken some pretty big write-downs on our property portfolio. So there's already quite a bit of damage in there.
Nikolai, the concern now, as you know, is over in China. At the start of the year, you and Lisa caught up in Davos, I believe, and we were talking about China reopening and the boom everyone expected. That boom just hasn't materialized. There was a threat to pushing inflation higher, and now they're exporting seemingly disinflation. Nikolai, as you work through the fund right now, how exposed are you to some of those themes, and have you had to pull back in any way, shape or form?
Well, we have a relatively small investments in China, but you're right. The boom in China after the reopening has been less than we expected. Now, I guess the only advantage that we can see of that is there is less pressure on inflation globally on the back of that. But less good news for the Chinese companies.
Could you give me some detail on what exposure you have in China, Nikolai, where that is?
Well, we are like between 3 and 4% in China. And if you add on Hong Kong and Taiwan, we are at 7-8%.
Are you worried about the lack of transparency in the last few days or so when they start to pull back on offering information about youth unemployment? Does that concern you?
No, I wouldn't say the one particular number on youth unemployment has scared me. But, You know, we are an extremely transparent fund. We love transparency. We were just voted the most transparent fund in the world. So generally, the more information we can have, the better it is.
There's a broader question about whether we're seeing a sea change in terms of some of the global allocations and some of the views on traditional haven assets. And I think about not only with respect to sovereign debt over in the East, but over in the West as well. People have been talking about the deficit in the U.S. and how that could potentially cause difficulty, indigestion among buyers. Is that a problem for you? Is that a concern for you? Have you started to shift and diversify it all away from treasuries and your bond holdings?
No, we have not shifted anything on the back of this.
So are you looking to really understand this or have conversations with policymakers? Is this sort of weigh in on any of your considerations when you look at credit or you look at any interest rate hinged assets?
Well, we have big teams who look at this and who are in continuous conversations with policymakers and so on, but we have not made any changes lately.
Nikolai's done interrogation training. Ramo, do you not know that?
Are we interrogating? Is that what we're doing right now?
The skill is short answers.
Well, it's good. It's good, and honestly, it's evidently, useful.
Nikolai, the year so far.
Well, you know from that theory that a shorter answer on average are more truthful than the long answers.
They're very true.
That's actually true.
Very true. Nikolai, they don't lend themselves to fantastic conversations sometimes, though. So I'm going to do my best just to get a bit more out of you if I can. And Nikolai, the year so far, as you know, has gone from soft landing to no landing to hard landing, back to soft again. There is this idea that we can somehow escape the inflationary threats of the last year without an economic downturn in the United States. Do you subscribe to that theory, or are you in the camp where you're expecting rates to stay higher for longer here?
I think they will stay high for longer, and we've been saying this for a very long time, and I still continue to think that's the truth. Now, one of the new things here is that the link between climate and inflation has become stronger. And we recently seen, the climate impacting harvest prices such as olive oil, coffee, beef, all these kind of things. But the new thing is really that the change from global warming to global boiling has meant that there are parts of the day where you cannot work across the world. And so productivity in society is decreasing, and that is a new inflationary pressure.
Nikolai,
and so
Spain,
therefore the link between climate and inflation is stronger than before.
In Spain, as you know, for a long time, that's been true. They call that the siesta. Where are you seeing elsewhere that's happening? Where is productivity collapsing because of climate risk? Is it in countries outside of the traditional places we'd look in Europe? In Italy, in the south of Italy, it's been the story you stop work in the middle of the day forever, for as long as I've known. Where is that a new development?
It's a new development in many countries, and we've seen heat waves in Europe that I've never seen before. July is the hottest month we have seen since the world began. So this is new, and it's getting worse.
So from
it's not called siesta anymore.
What's it called now?
It's called global boiling.
So from your perspective, for someone who's got to run a fund with exposure to these things, what have you changed?
I just think you need to be more conscious about inflation and take into consideration that the inflation may actually be higher for longer.
Okay, Nikolai, we'll leave that there and we'll build on it in the future. Thank you, sir. Nikolai Tangen of the Norwegian Sovereign Wealth Fund. Lisa, on some of the risks around climate, productivity and the inflation story going forward from here. He's been pretty clear on this one. He thinks higher for longer is where we're going to be.
And he thinks that returns are going to be more muted going forward, that it isn't going to be just a straight line the way that it has been traditionally. It's a challenge to understand exactly how to game out some of these new trends and to say this time is different in a more material way. They've been trying to do that at the same time that they have to be fully invested. And their goal is to diversify away from the oil largesse of Norway.
I'm going to go. It's all yours now, all right? Coming up on the Open, Brian Weinstein of Morgan Stanley, Sarah Hunt of Alpine Saxon Woods, Marilyn Watson of BlackRock. Looking forward to the conversations with them around the Open about the themes will continue around things like higher for longer, whether we are shifting back towards that so-called no landing, which isn't really a thing, but ultimately it means this Fed's going to have to go further. It's the Neil Dutta view of the world, Lisa, and whether you should be worried about reinvestment risk in this bond market, and we'll throw in a little bit of China into the mix as well.
Can we come up with new nomenclature? Can we come up with some new phrases?
Sure, what would you like?
It's like, the new normal, or I don't know, I guess that's not new. I'll have to think about it. Okay. I'm going to come up with something
new.
Thought.
I'm excited for tomorrow morning.
I'm going to unveil my new stage.
Nice. From New York, this is Bloomberg.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Just moments away from the latest housing data at a time where people are wondering when will the resilience, when will the strength in a lot of aspects of the U.S. economy. And what we're seeing right now is not a lot of drama after several weeks of losses. Just to give you a sense, so far this month, the NASDAQ is down 4.9%. Apple shares down 9.5%. Today, they're little change, although the S&P a little bit soggy as the session grows older, down 0.1% ahead of the open. We can see the euro gaining just a touch for the dollar, but still in that 109 range, and yields now up 4.21 for almost 4.22% on the 10-year. Right now, we are getting some housing starts and building permits, and what they show is surprise, strength, resilience, upside surprise in housing starts coming in at 1.45 million versus the 1. It was basically in line. I mean, it's just a slight touch higher, and we're also seeing a bit of a downside surprise on building permits. This comes as this has been an incredibly hot area, with gains in terms of home builder stocks rising about 47% or something so far this year. When we take a look at the revisions, a bit of a downward revision to the prior month for housing starts, a bit of an upward revision for building permits, so pretty much a wash. But what we can see is this ongoing continued focus on creating inventory at a time where there's utter stasis in the housing market. Why would you leave if you have a less than 3% mortgage? And that has been something that has been a theme. We did see in the retailers strength, particularly in TJ Maxx, as retailers that cater to the off-brand market do continue to gain disproportionately, and the shares are gaining there. And it raises this question, what will it take for this strength to come down? Will it come down naturally, a sort of immaculate disinflation, or will it take higher rates and some sort of recession? Kara Kadana has been brilliant on this point, chief U.S. economist at BNP Paribas, who has been talking about how he will expect inflation to keep coming down, which it has this year, and that there can be some relief from the Fed to move away. Carl joins us now, I'm so pleased to say, a good friend of the show. Carl, what's your take on the resilience, just starting with the housing market, that we continue to see there?
Well, as we look at this morning's numbers, I think when housing starts tell you one story and housing permits tell you a slightly different story, permits are the one you're supposed to trust, because housing starts can be very volatile due to weather and other types of factors that cause some choppiness on a month-to-month basis. The housing data have been in a pretty sour environment for the last several quarters. The pace of decline is slowing, but with affordability as low as it is and mortgage rates hitting new highs on a daily basis almost, I think these are some real constraints going forward. Of course, the inventory shortages that you highlighted are a big factor supporting activity, especially encouraging new construction. But even yesterday in the home builder sentiment survey, we saw that buyer traffic, prospective buyer traffic, is extremely low, and home builder sentiment declining for the first time this year.
So extrapolate that into retail sales. Are you saying that you're seeing similar signs that it cannot continue to have the same kind of robust gains in consumer spending that we've seen?
Well, Lisa, I see some significant headwinds emerging for retail sales and consumption more broadly in the back half of this year. Now, as we dissected yesterday's retail sales data for July, and maybe Amazon Prime Day helped to support the numbers and whatnot, but as we went into the details, it looked like discretionary spending was particularly strong. So the sporting goods, hobby, leisure, restaurants and bars, all the things you would spend on if you have extra cash in your pocket, those categories were actually the strongest categories in the report. So things are on a solid footing in the month of July at least. But as we go into the back half of the year, we know that labor activity is slowing. We know that income generation from labor activity is decelerating as well. We have student loan payments resuming in October, so there's questions whether people will immediately jump back into paying those loans or not. But with an annualized price tag of about $100 billion, it could have a very significant consequence, even if it isn't fully felt in the initial months. You have a potential government shutdown coming in the back half of the year, and also all those excess savings generated during the pandemic have been getting spent at a pretty healthy clip, whereas we think the kind of excess savings will be fully exhausted by the end of the year. And as we look by income quintile, we can see really the lowest three quintiles. That's a significant share of the population. The lowest three quintiles have basically exhausted those savings already, which should mean more price sensitivity among consumers, which helps on the inflation side, but also a slower pace of consumption as well. We're not there as of July, but that's something we're watching for in the back half.
People have been saying this for a while, and then you see house after house push out their forecast for recession and say, well, maybe it's not happening as soon as we thought. Can you give us a sense of what gives someone conviction that it will eventually happen, even though month after month, everyone had expected some of these consumers to run out of cash by mid-year? Now it's the end of the year. Maybe it's early next year. When does it sort of start to shift to, okay, maybe this is sustainable?
Well, I think that, as we see new data coming in, there has been more resilience in the labor market than a lot of folks anticipated earlier this year. Jobless claims, we've had a few false starts where they've started to back up, and it looked like maybe there was some deterioration in the labor market, and then kind of the numbers came right back down and whatnot. So, those kind of like canary in the coal mine moments proved to be false flags in the past. But if we look at the broader trend, we do see that it is slowing. So as nominal GDP growth decelerates, as payroll gains decelerate, this does change a lot of dynamics in the economy, including corporate profit trends, which as corporate profits decelerate, that has an implication for both capital spending plans and also hiring plans. You still have a tightening of financial conditions or of lending conditions from the banking sector that we can see showing up in the Fed surveys, banking surveys, bank earnings, et cetera, et cetera. So there are some problems that are becoming pretty intense headwinds in an economy that's slowing already. But getting the timing right has been problematic for forecasters more broadly. I don't think we're at the point where you're supposed to throw the recession call away and it's kind of immaculate disinflation and a soft landing for the economy. I'm still skeptical that we'll really be able to pull that off because monetary policy, as we know, is a very blunt instrument. And so kind of finessing the landing to have no contraction is something quite unprecedented. And so I would be surprised, given the speed with which the Fed tightened policy, if we can nail the landing, given the uncertainty over lags and the net impact.
So do you think, Carl, just to sort of underscore what you're saying, do you think that right now bond markets have it wrong with a 4.2% yield on a 10-year? Do you think that people are getting over their skis in terms of how high rates can be and how long the economy can be strong?
Well, ultimately, those longer dated yields are going to be a function of real growth in the economy and inflation trends. So if you think that there's a kind of a persistently higher inflation trend over the longer run, then you can make a case for 4% or higher on yields. We do think that we will see some pretty impressive cooling of inflation pressures over the next several quarters. We think inflation will be back to target by the end of next year, and I think that maybe part of that higher inflation for longer camp may have to revise some of those estimates as we see the economy decelerate, the labor softening, and a lot of these inflation categories moving in a favorable direction. The rent story alone is a big factor for the inflation profile. That's coming down. That's a very big component of the CPI, or the inflation basket, that's decelerating. You have goods prices showing further signs of moderation. So the real question will be the labor market dynamics. And if we do get some softening of labor conditions and wage pressures coming down, then I think that might alleviate some of those inflation concerns, which then could factor into where longer-term yields are headed as well. So I don't know that they're getting the story totally wrong, but maybe assessing it as being a little bit too hot at the moment.
Just real quick, Carl, what's the one question that you want answered by Jay Powell next week at Jackson Hole?
I'm very curious, given the theme is structural changes in the global economic outlook, to watch the degree to which this might be setting the stage for changing inflation targets or things of that nature. Now, this is the conference, or the symposium, is put on by the Kansas City Fed, which is notoriously hawkish. So this may be a way of kind of chopping down the straw men before they can even get any firm anchoring. So rather than saying there are structural changes and we should change the inflation target, they can say, well, there's our structural changes, but these are the reasons why we don't think we should be changing longer-term estimates for growth, inflation, or inflation targeting.
Carl Riccadonna of BNP Paribas, thank you so much for being with us. As always, we are looking at a little market reaction to that housing data as people see it as consistent with a theme that we've been hearing about, with relative strength, relative resilience, albeit slight cooling around the margins. We have been talking all morning about a fresh report from Bloomberg's Sri Natarajan and Sonali Basak on the future of Goldman Sachs CEO David Solomon and his possible successor. Something that is of great interest to Wall Street. President John Waldron is the person in question. They wrote, quote, as bitterness festers in the ranks this year over Solomon's leadership, Waldron is being pressed by colleagues to pick a side, beat his own path to win over disgruntled executives, or risk being seen as an affable clone of the CEO. Sonali Basak joining us now. Sonali, a really interesting development on the heels of a whole host of reporting. What has the response been like? What is the support for a John Waldron-led Goldman Sachs at a time where there are a lot of questions around the current leader?
Yeah, those questions around the current leader have drawn a sharp eye on John Waldron, and the tough spot he's in is that this unrelenting loyalty and intense drive has really been a hallmark of his personality. So this tension to break with David kind of goes against that, doesn't it? And you have not seen John break with David, but you have to remember something interesting. When the investment bankers kind of came and took over the top of Goldman Sachs, David and John, the traders do, by and large, love John. And so he has won the hearts of the inside of the firm as well, largely, as well as the client base. And we have a few of them quoted in our story as well. It's his style, Lisa, his kind of down-to-earthness that clients have really related to. You think of Stanley Druckenmiller, for example, saying that John Waldron is blue-collar, from the Midwest, down to earth, and that is what they're relating to relative to David's more abrasive style.
So he's trying to keep that popularity as he moves toward a pretty tumultuous time. I feel like this is the topic of discussion because it's a slow summer. Is that at all what's going on?
Well, it's kind of in a story that's been under the surface brewing for months. And the natural thing is, with so much pressure on David, to look at the number two. Remember, John Waldron has also been in charge of the strategy. And the clock is ticking. We've been talking about this for the last couple of days, that we're halfway through the third quarter here. And they really need to figure out this consumer business. They need to bite the bullet. They need to figure out how to make these changes in order to save themselves from another tough quarter. We're going to come back from Labor Day, and very quickly we're going to head into another earnings season, and Goldman has to put up better results than they've been putting up the last couple of quarters. They all know that, and that is largely under John's purview as well as David's.
If you're just joining the program, we are seeing a bit of a reversal in S&P and NASDAQ futures, with the S&P lower by about 0.1%. Sonali Basak, you talk about succession plans, and this is really the curious thing to me. We've seen increasing numbers of firms come out with succession plans recently. There has been a changing of the guard in the post-pandemic era, particularly in private equity, in a lot of different firms. We've seen that at Morgan Stanley. Is Goldman Sachs ready, or has there been too much turnover already for people to be saying this is the natural progression of things?
The question about John taking over one day, whenever that would be, there's an interesting question underneath the surface. They've lost a lot of people. We've talked about this a lot. What becomes of Stephanie Cohen? What becomes of Julian Salisbury? What becomes of the existing partners like Mark Nachman, Jim Esposito? There's a lot of tension. There's a lot of heated competition in terms of taking the top spots of these jobs. You look over at Morgan Stanley. They have not yet named a new CEO, even with James Gorman saying he would step down in a year. And that race is also quite intense. And you're watching James Gorman also try to make that as smooth as possible and retain whoever might not get that top spot. And so you are seeing kind of a changing of the guard. And it's not easy. It's often messy. And it also leads to very material changes in how these businesses may operate moving forward.
It's a changing of a guard, perhaps in a changing of an environment, a sea change in terms of interest rates and where they will end up. Bloomberg Sonali Basak, thank you so much. As we try to reimagine, reconfigure investment banking in an era of significantly higher rates, and that's been something a lot of people have been talking about. Coming up, we're going to dive into the housing sector. Skylar Olson of Zillow joining us to talk about how long housing prices can stay put, even with mortgage rates where they are.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Authorities
could face bigger challenges next.
was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make this decision.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Think about the headwinds of rising interest rates. You have student loans that are coming up in October. The average household has $6,200 of expenses, and you're going to get an increase of 3 to 8% of spend coming from student loans on top of that. There's less to go around. And so that's why there's the focus on essentials and a reduced focus on some of the aspirational items.
Trying to understand some of the strength that we've seen in retail sales across the board, both this morning with TJ Maxx and to some degree Target, as well as yesterday's data. That was Dana Telsey, Chief Executive Officer and Chief Research Officer at Telsey Advisory Groups. We are about 44 minutes away from the opening bell here, and we do see a little bit of calm deteriorating as the session grows older. Not a lot of drama, just a slight softening after yesterday's softening, after what we've seen over the past couple of days. Really led by the bond market with yields higher across the board, but particularly on the long end. Again, not a lot of drama today, but how far we've come is dramatic. We have seen about a 25 basis point move in the 10-year yield so far this month. We've seen about 31 basis point moves upward in the 30-year yield as people game out higher for longer, how long this economy could sustain higher rates. One of the big question marks underpinning that has been the mortgage market, has been the housing market, which we have seen hang in there. The surprising ramification of higher yields is just less mobility. And all of a sudden, inventory is scarce and it pushes prices even higher. How long can that go on? And where does that leave rental prices that have been one of the main inputs into headline inflation? Joining us to discuss all of this, Skylar Olson, chief economist at Zillow. And Skylar, I want to start on the rent part because that has been a huge mystery. Are you surprised that we get a different message from everyone about where the direction of rents seem to be going?
No, not at all. I mean, this is an incredibly challenging space to do research in. Rent is not a public record. So when you hear data out in the world about what's happening to rents, it's a lot of research shops like Zillow forming data from our rental listing market. So Zillow has a massive and diverse rental market from single family to multifamily. When we report on rent, what we're doing is we're pairing the same listing and then looking at that change of price. So it's a repeat rent index, kind of like a Case-Shiller home price index. Looking at that kind of formation, we have rent slowly trending down and actually hitting negative in a seasonally adjusted way. But when we're looking at the course of, seasonal patterns, that's also, what that data set looked like back then. It's such a hard kind of space to do analysis. That said, I think we are noticing softer pressure than pre-pandemic. That should be a good sign for general inflation to continue coming down.
Okay, so just to build on that point, this has been one of the main reasons why people say that inflation is going to inflect lower because rents are coming down and the housing, the owner's equivalent rent will also continue to be either a real tailwind for this disinflation trade. How much, and you're crossing your fingers there, I can see, how much do you buy this? How much do you believe this is sustainable versus just a cooling down after the incredible run-up that we've seen in rents over the past couple of years?
Yeah, well, it's interesting that you say sustainable, right? Because rents and how they change over time is going to matter a lot for the supply picture as well. For a while, we had seen multifamily permits kind of continue at an elevated space. And we've seen that pull down as well as the completes have finally been delivered in the multifamily buildings. We had such large rates of under construction, so many apartment buildings under construction, but it takes a while for those to actually be delivered. Over the last couple of quarters, that's when we started to see an elevated number of completes in this space, but then we saw permits come right back down. So in terms of how long will we see soft rent without going into a recession, there's so much uncertainty on that end. I don't know. I mean, we could see it stabilize again at just a, steady and slower pace as opposed to falling.
Moving from rents to just simply home prices, I'm curious what you're seeing currently in terms of how people are purchasing properties. Are they incurring a mortgage rate of 7.1 to 7.5%? Or are they buying still in all cash? Are they buying with a loan from the developer? Are they staying away from previously occupied homes exactly because of the mortgage question?
Oh my gosh, all of the above. From research from Zillow Home Loans, we know that more than half of buyers are buying down points. So that's probably your first and most obvious strategy. We've also seen, new home sales perform so well. You can see that people are turning to that kind of inventory while new listings falling into the market remains close to a third below where it was pre-pandemic. I think what we're watching and observing, if we talk home prices, is demand, at least enough fundamental demand, getting creative and making it work and pushing forward. If I took the most recent seasonally adjusted month-over-month growth in our Zillow Home Value Index, that annualizes out to a pace of 7% nationally. That's pretty darn strong. And it has everything to do with a pullback in that supply side as well.
So how sustainable is this? And this is something we were talking about with a guest a couple of days ago where they were saying that if you take a look at the affordability of these homes for the average individual household, it looks less and less affordable, especially with mortgage rates where they are. And that in order to bring things back into a balance as they were pre-pandemic, you'd have to see a 30% decline in some of these valuations. Why have we not seen that? Is it just a supply and demand? Is that sustainable? Or is there something unhealthy about this dynamic?
Yeah, I mean, so this idea of sustainability also kind of flows through, like, what are the market signals that are gonna pull people in and out? The reality that I'm seeing from my, we're very sensitive to thinking about the inventory side of that picture, operating, a for sale marketplace. And so that's a big part of our forecasts. When we forecast out new listings, that's a challenging picture if rates remain high. And so our forecasts also maintain this pace. If we think about what that means for affordability, right, I think there are a few things. One, I almost never show a graph anymore about the share that you would need to spend on a mortgage payment without showing you the difference between if I'd had 10 or 20% down. So some people, will take much longer to lower that dead loan and achieve affordability. Some people still also think, rates could come down. There might be consensus that it could come down in years to come, but that path that it will take there, as we've seen over the past couple of weeks, clearly incredibly uncertain. It just all comes back to supply. We just, for prices to come down, competition would have to ease up. And there's simply too much of that fundamental demand moving forward to make it work, and no supply entering the picture.
There's a theory that if rates were to come down, and we are seeing mortgage rates at the highest levels since 2001, if they do start to come down, you will actually see inventory loosen up, that people might be more willing to sell or to buy a new home and to move out of their old home. Do you think that counterintuitively, if rates go down, we see housing prices go down as well, because simply there is more supply?
That is an interesting idea. And, honestly, for housing prices to come down a little bit, I don't think would be bad for the whole system, because we are sitting on top of record amounts of home equity. When I think, what's going to happen, and I think you're right, I think rates don't even have to come down too much to unlock some of these would-be sellers. We ask, every quarter, existing owners, do you intend to sell over the next 3 years? Consistently, that was 16%. Over the last 2 quarters, that popped up to 19, and then up to almost a quarter of existing owners wanting to sell their home in the next 3 years. I don't think you say that if you're deeply, deeply, deeply locked in and aging in place. We also saw from that survey, owners with mortgage rates above 4% are twice as likely to fall into that group. So a bit of relief could unlock supply. That's something I certainly hope for, and I think would be actually a very healthy injection into the for sale market.
Just 30 seconds, that's all I have left. I'm curious, Skylar, do you think that
the Brexit will be net negative on the UK economy? No question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe, similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
At
think we're all hoping for a quiet summer's morning. From New York City this morning, good morning, good morning. Your equity market slightly negative on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York coming up, Fed officials unwilling to declare victory, Secretary Yellen leading the Bidenomics PR tour, and China attempting to stabilize financial markets. We begin with the big issue, too much of a good thing.
This resilient economic backdrop.
Resilient. Very, very resilient. The economy surprised to the upside.
Labor market in the U.S. has held up pretty well.
Labor markets are tight.
There's more money in household pockets.
Inflation has been falling, pretty notably.
It removes a sense of urgency for the Fed to normalize policy quickly.
The Fed will have to be more aggressive, raising rates higher and keeping rates higher for longer.
Interest rates are going to stay higher for longer.
Higher for longer.
We are not certain that the last hike is behind us.
One more hike, that's likely.
Does this resilient economic backdrop leave the Fed in a position where the bar for rate cuts is very high?
I think we'll have to watch out how the data play out.
Try to take advantage when bad news becomes bad news.
There are reasons to be concerned.
A downturn potentially and eventually will come.
It's premature then for FOMC members to go out and already talk about cutting interest rates.
The soft landing scenario is the worst case scenario.
Joining us now to discuss exactly that, Morgan Stanley's Brian Weinstein, Sarah Hunt of Alpine Saxon Woods. To the two of you, thank you. Sarah, first to you. Is there such thing as too much of a good thing?
Well, it's really interesting how fast the narrative has changed from a soft landing is going to be great to, oh my goodness, a soft landing means we have to keep rates higher for longer. And then all of a sudden we start running into these things like the maturity wall and concerns about interest rate payments. I think there's been a lot of expectation that the Fed would cut rates after a short period of time, and therefore you didn't have to worry so much about higher rates and it would be okay and housing can go back to, mortgages can come down. I think that there is too much of a good thing right now, and I think that that's starting to concern people.
Sarah, you and I have talked about this a million times. We've gone from soft landing to no landing to hard landing to soft. Brian Weinstein, where on earth are we now in August?
You know, John, you said everyone wanted a quiet summer. I think the market's being indecisive here, right? We're settling into a range. We're trying to find out where interest rates are going to go. We tested 3.3% early in the year. I don't think we found the high end of the range in interest rates, but I think the market is basically saying exactly what you guys just were going over, that where this looks like a soft landing, it's not too much of a good thing yet. We just want to, we're okay here, right? A 4.25 10-year note is not really hurting anybody, and the equity market seems perfectly happy hanging out around these levels.
Brian, not much of a landing at all. Rates are through 5%, unemployment at 3.5%, CPI is above target, retail sales, massive upside surprise in the last 24 hours. What landing do you see?
Yeah, again, there's no landing in sight. Although, Jonathan, let's be honest. If you look under the hood, default rates are picking up in corporate America, right? If you look at the high yield market, the loan market, you know, the Fed raising rates is just starting to bite. So, while it looks like no landing now, I think on a forward basis, there are not terrible things happening, but this looks like a real business cycle. There are winners, there are losers, and you have to be careful where you invest. It's going to get harder from here, not easier.
Sarah, is the underlying growth story that you expect to develop in the next several months, next several quarters, is the unemployment rate, the labour market with unemployment at 3.5% consistent with heading back to 2% anytime soon?
I think that's going to be very tricky. And I think you've also started to see some of those commodity prices add to the inflation picture. Just as we thought inflation was just coming down and it was going to go in one direction, I think you might see some inflation uptick on that. And it's not just about energy prices in terms of gasoline. It's also about how that impacts the whole input cost chain. So I think that the desire of inflation directly down without any bumps in the road is also going to be the sticky one for the Fed. And I think it's going to be, I love the comment that it raises the bar very high for a Fed rate cut. I think that's going to be the tricky part going forward.
It's a tricky debate going into Jackson Hole about a week away, the annual Federal Reserve get together. Plenty of Fed speakers speaking over the last week. We've heard from Neil Kashkari. Take a listen to what Neil had to say.
Are we done raising rates? I'm not ready to say that we're done. In terms of cutting rates, I think we're a long way away from cutting rates because core inflation is still around 4%. It's still around twice of what our target is.
We've got work to do. Matt Bosler joins us now from Bloomberg. Matt, it's been far too long, a week away from Jackson Hole. Matt, what do you think is on the agenda for the Federal Reserve and Chairman Powell and the team?
Yeah, so the big question is how big these two relative camps on the FOMC are right now in terms of people who think they're done raising rates and people who think maybe they still have a little bit more to do, like Neil Kashkari was indicating. And we'll get a bit of a clue from that, probably from the minutes of the July FOMC meeting that are coming out later this afternoon. We're hoping to see, if they kind of flesh out some of the Fed speak that we've gotten since the July meeting. We've got some people like Philly Fed President Pat Harker saying, maybe we're done, we can probably hold here. We've got other people like Kashkari and San Francisco Fed President Mary Daly, Fed Governor Michelle Bowman saying we probably have more hikes to do. So I think that's kind of the big question for today and going into next week.
Matt, there's some splintering on the committee. Given that splintering, Chairman Powell's in a difficult position to really reflect a consensus that does not exist. When you have to make a call right now, what do you think the chairman wants to communicate? 12 months ago, it was easy. Inflation's too high, need to get it down, need to be aggressive. What do you think the message needs to be now?
Well, I think the message is, that they are not done, right? Their inflation is still too high. We've heard that pretty uniformly from Fed officials across the spectrum. And so there's going to be that, ongoing commitment to bringing inflation down. But I think we're starting to shift a little bit more toward, how long are we going to hold rates at peak levels versus are we going to keep raising them from here? And so, when you look at the projections from Fed officials, they show rate cuts at some point next year, but we don't really get a sense of when they start because, of course, those projections are labeled for the end of each year. And so I think that kind of question of when do those rate cuts start commencing, and then also how much do we get in terms of rate cuts next year? Those are going to be kind of the big debates going forward, and maybe we'll get a little bit of a tease from Powell next week at Jackson Hole on that question.
Hey, Matt, thank you. Come back soon. Matt Bosler there, one of the best on the Federal Reserve here at Bloomberg. The whole of the team just fantastic going into next week. Brian Weinstein, this Federal Reserve, do you think based on market pricing right now, there is room to reappraise policy pricing more hawkishly than we have over the last few weeks?
No, I really don't think so. I think there's more of a consensus than it sounds. I mean, the Fed needs to sound steadfast on inflation. They are. They want to keep rates higher for longer, but they don't want to go anymore, tinker with 25 basis points again just to say they did something. I think they believe they've done a lot. They want time. They need a lot more information. We're not one CPI print away or one unemployment print away from their changing their minds. So I think they want to stay here, and I think they want to say very little. Just keep saying what they're saying and let the market sort it out, and then they can tell over the next 6 months how much impact their rate cuts, their rate hikes have had before they discuss anything else.
Brian, this bond market's done a lot over the last month, including the last 4 days. We're back through 420, unchanged on the session. Previous 4 days, it's been a move of like 20 basis points, Brian. There's some notes that I've got from you, and there's this line that jumps out to me. Beware of duration, the long end is not cheap. Is 420 not cheap on a 10-year?
No, I don't think so. I don't think we're there yet, Jonathan. Like, listen, you come into the year at 390. You expect about 100 basis point range on average. So we did the 60 down. We've done 30, 40 up. We're close, and I think we can settle into a range here. But I don't think we're trading 330 to 420. I think you have to think about a range of maybe 390 being the low end now, and I don't think we found the upper end yet. I think inflation is sticky. Investors need some risk premium in there. A lot of supply coming. A lot of lack of foreign demand. I think rates are going higher than here, though the quick part of the move has happened. It'll be more difficult, orderly, and a bit more slow, but I think we're going higher.
Sarah, do you agree?
Yes, I do, and I think that that's exactly part of the problem, right? And what Brian just said was excellent in terms of timing. The Fed needs more time. Wall Street people and market people are so used to having instantaneous information. Prices change so quickly, and we can see the effects of earnings coming out on a stock or something else. Those moves on interest rates in the economy take a lot longer to flow through. And I think that feeling has been, well, they haven't flown through by now, so they're not going to flow through. And I think that's really the problem. And if you look at where the market's pricing out rate cuts to start, I think that if you have to wait 6 months, we can't possibly start rate cuts in that interim unless something really bad happens. So I think that the tension there is higher rates for longer, which has been sort of the drumbeat of the last week or two.
There's a tension there in the credit market too. Sarah, you mentioned it about 5 minutes ago. You talked about the maturity wall on the horizon. If you're both right, if this Fed is not cutting anytime soon, if you're both in the camp where we're going to be higher for longer, then at some point, Sarah, credit spreads at 375 on high yield don't make sense, do they?
No, because I think a lot of people, unlike the U.S. government, which I've said before, termed out their debt. And they've been waiting to see, okay, so rate cuts are going to come. I termed out my debt. I don't have to worry about any short-term maturities. As rates stay higher for longer, that starts to change. And if I've got to refinance debt, that's going to bring my cost structure up. If my cost structure goes up, what am I going to do? I'm worried about my margins. So then you start to get into more layoffs. I think that companies were so scarred by the pandemic and not being able to get labor back that they've been much more sticky about keeping labor longer. But if the other input costs start to come up, I don't see how they can continue to do that.
Brian, final word on that.
No, I think that's right. I mean, you look at high yield spreads and go, I don't love them here, but look at the yields, right? So you have a lot of cushion. There are going to be defaults. There are going to be increasing defaults. I don't think you want to own just the index. You have to choose which bonds you own. So there will be a credit cycle. Things will get more difficult. Higher rates will put pressure on companies, but it'll also bring in investors. So higher default rates, but I still think you can have decent performance as credit spreads widen from here.
Brian Weinstein. Sarah Hunt, you're going to stick with us. We've got more to talk about, including the latest over in China. Tons to talk about in China after the rate cut earlier this week, which felt like a lifetime ago, didn't it? The data's been pretty weak as well. And then there's some tweaks to policy we need to discuss too. Equities right now negative on the S&P 500 with some movers. Here's Abby.
Let's start out with the shares of Target, John, because they are absolutely soaring. And this after the company put up a huge profit beat, 300% above what they put up a year ago, but also beating estimates. The stock up 6.1%. And it's one of those rare times when the quarter that was reported takes precedence over the outlook, because they actually are sort of cautious on the future, but relative to that big earnings beat, it had everything to do with pairing bloated inventories. Coinbase up 4.5%. They've won approval to start hosting crypto futures in the U.S. and operating a futures commission merchant exchange. And then Coherent, the semiconductor company, well, they offered a weak forecast. They're saying that it's a reset year plus macro headwinds. That stock absolutely plunging.
Abby, thank you. More from Abby around the opening bell. Coming up, China looking to support fragile markets.
We're pretty cautious on China. The sentiment issue, frankly, is what's going to keep people out a little bit. You know, foreign investors, I think we're not happy with how they were treated by China over the last couple of years.
That conversation coming up next, about 20 minutes out from the opening bell. Equities just a little bit lower. Good morning.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We're pretty cautious on China. The sentiment issue, frankly, is what's going to keep people out a little bit. You know, foreign investors, I think we're not happy with how they were treated by China over the last couple of years. If you look at the foreign direct investment in China, it's come off a little bit. U.S. companies are clearly not putting money, directly in there.
That was Citi Stuart Kaiser discussing his investment strategy for China. This as the disappointing data continues, weighing on market sentiment and leading several banks to downgrade their growth forecasts. Policymakers stepping up their support. According to people familiar with the matter, attempting to stabilize financial markets by asking some investment funds to avoid being net sellers of equities. Tom Ehrlich joins us now for more down in Washington. Tom, let's start here. Just the policy shift. What are we hearing about what they're doing now?
So there's been a flurry of moves overnight, Jonathan. We've had that request from the securities regulator that you mentioned, asking funds not to be net sellers in the market. We've also had the PBOC amping up liquidity injections and providing some firm guidance to the currency market, aiming to stem the depreciation of the renminbi. What does it add up to? Well, so far, I think we're still looking at micro moves. There's nothing here which adds up to the kind of big bang which the markets are looking for in order to turn sentiment around.
What does it mean for us, Tom, is a question you and I have been exploring. You wrote, together with the team yesterday, Powell's new problem may be made in China. Tom, some people have pushed back against that, made the argument we're somehow insulated, the Fed won't be setting policy for what happens over there. What would you say back to that, Tom?
So if we go back in the history books, Jonathan, it's not that hard to find examples of moments where China did move the dial for the Fed. Think about the end of 2015, where we had equity markets collapsing, the yuan collapsing, and that was enough to put the Fed on hold and knock a bunch of rate hikes off the agenda. What would it take for that to happen again? What would it take for China to push the Fed from what we think is going to be an extended pause from here into earlier than expected rate cuts? Well, I think we would certainly need to see a significant deterioration in the situation in China from where we are now. And we'd also have to see that sparking a global risk-off trade. That's what happened in 2015, and it was that global risk-off sentiment, that global tightening in credit conditions, which changed the trajectory for the Fed. We're not there yet, but with one of China's biggest property developers on the cusp of default, with protesters lining up outside one of China's biggest trust companies asking what's happened to their investments, and with the policy response from China's decision makers so far a little bit missing in action, clearly the risk is there.
There are things we need to think about. Tom, phenomenal work as always. Tom Ehrlich there of Bloomberg Economics. Poor data, weak data out of China, decent data stateside again. Upside surprise, industrial production month over month, 1%. The estimate 0.3. Manufacturing production 0.5%. The estimate flat, 0. It's a strong beat. Sarah Hunt, Brian Weinstein, back with us for more. Sarah, let's talk about China briefly. This is what we're reporting this morning. The authorities have asked some investment funds this week in China to avoid being so-called net sellers of equities. Does that instill any confidence in you, Sarah, to start buying?
That's a very difficult situation right now. And I think, this is not quite the outright ban on short selling that they tried a few years ago as well. But I think it speaks to the fact that you have this huge economy that is supposed to be part of the driver of the global economy as it's coming out of the pandemic. And you're starting to see some real problems there, and the kind of problems that we saw, quite frankly, globally in the 2007, 2008 timeframe. So the fact that they're having these big problems with both paying back from the trust company and a large real estate developer having big significant financial problems does not bode well for their demand for the commodities and for other goods outside of what they usually buy. That is a big driver of global growth. So I think that the problem is manyfold. It's not as bad as it was for globally in 2009 because you don't have as much interlinked in China with the rest of the world because of the capital control system, but I think it's still a problem.
Brian, how much more negative can it get just in terms of investor sentiment? I can't find anyone that speaks constructively about what's happening over there.
No, I think that's right. And we all know that, that China can stimulate when and if they want to, and in size, right? So they have some structural issues. They're trying to work through them. People are bearish. It's in the price. The 10-year note in China is 2.6%, which is pretty low if you think there's any growth and inflation in the future. John, I think one thing to worry about is if the Chinese do stimulate in a significant way, and that does stoke inflation, it makes the Fed's job really difficult. And it's, I think, one of those reasons why when you see some of this Chinese news, you're not getting rallies in the back end of the U.S. yield curve, right? If you get more stimulus in the system, it's really not a great time for the Fed, and it probably pushes global inflation back up at a time where growth is falling. So we're just at a tough juncture in the markets, and so everyone has to be careful how and when they stimulate in an inflationary world.
So, Brian, glass half full or half empty? Should I be happy they're exporting disinflation, or unhappy that the growth profile is leading to disinflation?
Listen, I think the world needs China to grow, right? And we see weakness in parts of Europe too. So I think people will throw out the term stagflation, which I'm not sure is exactly right. But if you have growth slowing around the world, that's problematic here, and you want China to pick back up. I think that's the bigger deal.
Work with me here, Brian. I just want to draw your attention to what's happening in the FX market. Dollar yen 145.85. Very briefly, just breaching that 145.90 level. Those of you who remember back in September, that intervention into the FX market, these were the levels. We're back close to them. Just briefly breached it, came back down. Brian, never mind China. Let's talk about the BOJ. Growth strong, inflation's hot for Japan standards over the last few decades, and they're still trying to control the yield curve. Do you think that's possible?
Not for too much longer, right? You're seeing it. The markets are testing policymakers, whether it's re-steepening higher yields in the U.S. or going after the yen or the 10-year peg, forcing the Bank of Japan to move it. The data there is incredibly hot. It's very hard to imagine you can keep rates here and the currency under control. You can intervene temporarily, but again, another reason to think rates can go higher globally is that market something is going to give.
Sarah, there's a feeling that it's their problem and not ours. That Japan has issues we don't have to worry about. That China has issues, they're not our problem. Do you share that view?
You can't really share that view. I mean, the entire global economy financially is very much interlinked. And even though China is a little bit outside of that just because of the way that they control their own capital, what happens in Japan does matter. There's huge holders of treasuries outside of the U.S. And the global market problems become our problems as well, as things are sold because they have to, not because people want to. So I think that you can't isolate yourselves. And I think that it is an issue for the U.S. markets. And I agree with Brian, it's also an issue for the Fed.
Sarah Hunt, Brian Weinstein, to the two of you, thank you. Breaking down a lot of complex issues right now worldwide, not just stateside. Equities on the S&P 500, negative by 0.2% on the S&P. Your update on the bond market, yields are just a little bit lower through most of this morning, though inflecting higher off the back of that industrial production number. Your 2-year still down by a basis point or so at about 493, after breaching 5% in yesterday's session for the first time since early July. Just very briefly, your new high for the year, by the way, on a 10-year, very, very close to 427 in yesterday's session, and we backed away as well from there. In the FX market, the one to watch, I mentioned it briefly, dollar yen, just breaking out a touch, positive by a couple of tenths of 1%, and very briefly through 145.90, the kind of level that triggered some intervention last time around. At the moment, 145.85. Coming up on this program, the morning calls, and later, Target topping Q2 earnings estimates. The stock up by 7.52% in the pre-market. The opening bell about 7 or 8 minutes away. The conversation still ahead with CFRA's Arun Sundaram.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Minutes away from the opening bell, looking at a second day of losses potentially here with the S&P 500 negative by just 0.2% going into the cash open. That's the equity story. Let's get you some morning calls. First up, Piper Sandler raising its NVIDIA price target to 500, expecting the company to deliver better than estimated results next week. That stock is positive by 0.9%. in the pre-market. Your second call from Mizuho, upgrading Chevron to buy, 209 price target, pointing to secular tailwinds and improving margins. That stock positive too, 160.30 in early trading and positive by 0.7%. And your third and final call from the team at UBS, upgrading Keurig Dr Pepper to buy, highlighting the stock's attractive valuation and what they call strengthening earnings power. The stock is up by, let's call it 1.9% to $34 and about 10 cents. Coming up on this program, target a curious one, crushing profit estimates, but a miss on the top line, a beat on the bottom line, and the outlook get cuts as well. But look at the stock, up by 7.6% in early trading. A conversation with CFRA's Arun Sundaram coming up shortly. Your opening bell just around the corner.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this Is story. there the kind of upside?
The story of the week so far, what Monday gave, Tuesday took away. Just about negative on the week at the moment, and we add to it. We take more away by about 0.1% on the S&P 500. If we closed here right now, early days I know, the week is still young, but if we did on the S&P 500, third week of losses, longest weekly losing streak of the year so far. We'll see about that. There's your opening bell. Switch on the board and get to the bond market. What a move we've seen over the last 4 days. Yields higher, yields higher, yields higher, yields higher. Let's see if we make it day 5 on a 10-year. 4.22, 28, yields up by a single basis point. The data in the last 15 minutes, manufacturing, industrial production, pretty decent. Upside surprise. In the FX market, the euro hanging on to 109, 109.10, and crude positive by 0.2%. $81 and about 15 cents. The one stock to watch at the open, its Target, better than expected Q2 profits, overshadowing the retailer's increasingly cautious outlook. The CEO saying this: the consumer is still challenged by the levels of inflation that they're seeing in household essentials. That's absorbing a much bigger portion of their budget. Abby has more. Hey, Abby.
Hey, John. Well, investors are really liking this quarter right now because this stock is up more than 8%, heading to its best day since March of 2022. And this stock has really been lagging its peers into today, down 16% on the year. Well, it's really halved that, now down less than 10% on the year. Now, it's also a very rare instance where investors are paying much more attention to the quarter that was as opposed to the guidance, because the guidance for the year, a range of $7 to $8 for profits, that's a little bit light relative to where analysts were, and it's 75 cents shy of where the company had been. As for the profit, though, this is a big story. They put up $1.80 in adjusted earnings in the July quarter. That is more than 300% better than what they did last year when they put up 44 cents. The interesting point, though, that you were making earlier, revenue is a little bit light, and that has to do with some of that weakness that Brian Cornell is talking about with the consumer, although it looks like the trend is a little bit better in August based on some of the comments they're making. Again, this stock up in a big way. Investors liking what they're seeing out of Target as it has, again, lagged on the year. Maybe a little bit of a catch-up trade here, John.
Abby, thank you. A bounce up almost 7% about 2 minutes into the session. Let's stick with retail. TJX topping earnings estimates and boosting the outlook, getting a lift from customers searching for cheaper alternatives. The CEO saying, I want to recognize the execution of our teams, focusing on bringing customers excellent values and an exciting treasure hunt shopping experience. The third quarter is off to a very strong start. Simone has more. Hey, Simone.
Hey, John. Yeah, the rationale for the enthusiasm we're seeing in these shares is a little bit more obvious than the Target story. Again, TJX, the parent of TJ Maxx, Marshalls, Home Goods. Overall comp sales in the second quarter up 6% year on year. The estimate was for about half that. EPS 85 cents versus 69 cents the analysts were looking for, and therefore the company raising its full year guidance, now seeing sales up 3 to 4%, previously looking for 2 to 3%, and for what it's worth, the street was looking at 3% for the year. Of particular importance to analysts is Home Goods. Citi said that they were looking for an inflection point here with home spending relatively light, and they saw one. Comp sales up 4%, expected to actually decline slightly. A very optimistic note from CEO Ernie Herrmann. Perhaps the reason we're not seeing shares move even higher is the fact that this looks like they're set for a record close today if they hold this level.
You raise your guidance, you're rewarded with a 3% rally. You cut your guidance and you get a 6-7% rally. The story of the retailers this morning. Simone, thank you. Levels matter, valuations, of course, past performance, all of that. I know. It's just a joke. 3 minutes into the session. Equities negative here by 0.1% on the S&P. On the Nasdaq, we're negative here by 0.4. Let's turn to the utility sector. Hawaiian Electric trying to rebound amid growing questions over whether its power equipment may have been a source of the wildfires in Maui. Analyst at Guggenheim writing this. Here's the quote. Given the size of the company, I don't know how they would be able to account for this if they are found negligent. Katie Greifeld has more. Hey, Katie.
Hey, John, yeah, shares were trying to rebound. They were up over 3% in the pre-market trading, but now as the bell rings, you can see Hawaiian Electric down 2%. If this holds, this would be a 7th straight day of declines, of course, with the company's future in doubt. For context, Hawaiian Electric supplies roughly 95% of Hawaii's residents with power. And like you mentioned, questions growing here over whether it's the company's power equipment that's the source of the Maui wildfires. And Wall Street isn't necessarily waiting to find out. Hawaiian Electric has shed $1.8 billion in market cap just over the past week. Shares closed at their lowest level since 2009 yesterday. And of course, analysts have been cutting their price targets on Hawaiian Electric in a hurry. And just yesterday, actually, S&P also downgraded Hawaiian Electric to junk status. There's no real news yet this morning, John, but you can see the shares wavering right now, currently in the red.
To your point, Katie, investors aren't waiting. That's half the market cap gone in just 3 days or so. Katie, thank you. Finally, just shares of Tesla under pressure just a touch again. The company cutting prices in China for the 2nd time in 3 days, lowering the cost of its Model S and Model X vehicles and fueling concerns of a price war. Ed, the 2nd time in 3 days. What's happening?
Yeah. There's so much to discuss here. First off, Tesla's down 1.5%. It's lower for a 4th consecutive day. It's the 2nd run of 4 straight days of declines in the month of August. And I think crucially, it's worth noting that the stock is down more than 20% since the July 19th earnings call, where Elon Musk said that further price cuts are completely possible. The news overnight is that in China, Model S and Model X got a trim of almost $10,000 US following the trims of $1,900 to the higher end Model Ys Monday. You will remember we discussed 24 hours ago that here in the US, Tesla had introduced a new base price for the latest generation of Model S and X, the net effect of which is to lower prices. So this is a lever Tesla uses. I reiterate, Elon Musk and other Tesla executives have said time and again that they're willing to sacrifice margin in the bottom line in order to protect the growth rate. I just want to point out very quick, John, a piece on the Bloomberg that just published from our global car editor, Craig Trudell. Because, of course, 24 hours ago, we were talking about how the PBOC had cut that key interest rate by the most since 2020. So because Elon Musk has put a lot of emphasis on rates, not just in the United States, but China is an incredibly important market for Tesla and other EV makers. So I never thought I'd be on this show talking about Musk, Tesla, and saying PBOC and key interest rate, but it's a core part of the story.
I didn't think I'd talk about Musk, Tesla, Zuckerberg, and mixed martial arts, Ed, but we have to do that these days too. Are we done talking about that, Ed? Is that conversation finished?
The latest is that Musk has posted to X a recap of the story, saying essentially when he challenged Zuckerberg in June, it was a joke. Zuckerberg came back with an acceptance, but then declined to follow up on it. I think we just leave it for the time being, John.
Good to know. The whole thing's become a joke. Ed, thank you, sir. Tesla here, down just a little bit. No drama here. We're negative by 0.6%. Let's turn back to Target. Big move here. CFRA's Arun Sundaram reacting to the numbers, writing, quote, "This was the definition of mixed results. We saw a huge bottom line beat, but sales fell well below expectations. We think it is unlikely Target will return to its historical 6% plus operating margin over the next few years." He maintains a hold rating, a 135 price target. Arun, I'm pleased to say, joins us right now. Arun, let's start there. I know what the market's focused on is this 2nd quarter profit rebound, this beat. Do you think we need to focus on the other stuff?
Yeah, no, I mean, I think what drives Target shares really is the bottom line. It's margins. That's the number one driver, I think, for Target shares. And this year, we're probably going to see operating margins around 4.5%, which is well below its historical range of 6 to 7%. And now, given the cut in the guidance today, I think it's unlikely that Target will return to that 6% operating margin, certainly this year or even next year. Next year, it's more likely that Target's going to approach operating margins around 5%. So still well below its historical number.
Are things getting better? You know this company inside out. The headwinds to margins over the last year or so, Arun, do you see any improvement anywhere?
Yeah, no, I think that what the bulls will be pointing to this quarter is the really strong gross margins and disciplined cost management. We saw gross margins, significantly recovered from the prior year, but the prior year was an outlier given all the inventory actions the company had to take. We also saw pretty good, operating expense discipline as well. Operating expenses grew less than we expected, and I think Target's doing well cutting costs. But unfortunately, like when you cut the top line, when you cut comp sales trends, you're going to face operating deleverage, and that's going to have an impact on overall margins. I think that's the big headwind right now. But the good news is that once comp sales trends do turn around, whenever that is, we should see some pretty significant operating margin improvement.
One word that we've all become familiar with, a word you know well, following the company, shrink, otherwise known as theft. Has that got better, Arun? Has it stopped getting worse?
Target said on the earnings call today that it may be plateauing, but that doesn't necessarily mean it's a good thing because that still means things are really bad. They're still seeing theft and organized crime. In fact, they did say today that year to date, they've seen a 120% increase in theft incidents involving violence or threats of violence. So it's still a problem. Shrink's going to be an issue the rest of this year. In terms of the fundamentals or the financials, comps do get easier by Q4 this year, specifically on the shrink number. That's because if you recall, last year around Q4 is when shrink became a bigger issue. So the comps do get a little bit easier, but it doesn't look like things are that much better than a few months ago or a few quarters ago.
They've had a tough go of it, as you know, and not just because of this issue, but also they've found it difficult to keep progressive customers happy and conservative customers happy at the same time. Arun, what's happening on that front, and what have they said about it now?
Yeah, they clearly made a mistake with their Pride merchandising and marketing, and that had a material impact in the quarter. They said that comp sales trends really started to soften in the second half of May, and that continued in June, which is around the time when the Pride merchandise backlash fell. But once they did pull that merchandise in June, Target did see a meaningful recovery in traffic and comp sales trends in July, and that kind of continued into August. So that's another reason why the shares might be up today. But it remains to be seen if this is going to be a longer term issue or not. It's clearly these days you have to be really careful of how you market, how you brand. Historically, these boycotts usually didn't amount to much, but times are different these days. Companies like Bud Light, for example, is clearly facing some issues there. I think between social media, the media, just polarizing views, you just have to be really careful how you market and brand. And clearly, Target, learned a lesson with this Pride merchandise.
An expensive one. It's a difficult moment to run a company, that's for sure. Arun, thank you, sir, for the update on Target there. Arun Sundaram there on the latest. Target, the stock is up in early trading about 11 minutes into the session. The equity market's positive too by 0.15%. Coming up on this program, the Bidenomics PR tour continues.
Wages are growing faster than inflation. Folks, that's Bidenomics.
The White House pushing Bidenomics as President Biden prepares to deliver remarks from the White House. The conversation up next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
I came to office determined to move away from the trickle-down economics. The Financial Times and the Wall Street Journal started calling my plan not initially as a compliment, Bidenomics. But guess what, folks? They're talking about it differently now. It's working. Because we're investing in America. According to Morgan Stanley and Goldman Sachs, my plan is leading to a boom. They call a boom in manufacturing. Wages are growing faster than inflation. Folks, that's Bidenomics.
Everyone loves investment banks when investment banks say nice things about you. When politicians typically talk about investment banks, they haven't got nice things to say. President Biden speaking on the anniversary of the Inflation Reduction Act. Secretary Yellen writing in the Wall Street Journal today, with the Inflation Reduction Act, we're delivering on what I call modern supply-side economics. It's a turning point in the national effort to preserve the planet and to shape a prosperous, inclusive and resilient economic future. For the second time this morning, we can say good morning and welcome back to Bloomberg's Anne-Marie. AMH, what's the latest on this PR push?
Good morning, John. Well, it is a PR push from the administration because while they want to tout Bidenomics and they want to make sure the message is getting across from the Inflation Reduction Act, which was signed into law a year ago today, which is tens of billions of dollars going to clean energy initiatives, it is not landing in terms of political success. When you look at some recent polls, CNN, a majority of individuals in America still think the economy is doing very poorly. And then when you look at this specific bill, which the administration has really been trying to tout, a blitz across the entire nation, whether it's Biden or some of his other surrogates, touting what this bill does. 7 in 10 Americans, according to the Washington Post and University of Maryland survey released earlier this month, say they have heard little or nothing about the law. So that's really the struggle the president is trying to make because, of course, he is going to be the contender for the November 2024 election.
We'll get the Republican definition of all of this in about a week from now. AMH, thank you. Down in Washington, good to have you back. Those debates, the first debate for Republicans taking place a week today, hosted by Fox News. Look out for our coverage of that in just the next couple of days. Looking forward to it. Joining us now is BlackRock's Marilyn Watson. Marilyn, on this fixed income market, we've seen quite a move in the Treasury market. This is going to sound political. I don't mean it to be political directly to you, but ultimately, Is higher Treasury supply the price we've got to pay for the kind of things the White House is talking about?
Well, so I think higher Treasury supply is, what we're seeing when, obviously the Fed is running off its balance sheet. We're seeing really the impact from the previous few years when we saw a huge amount of support in terms of buying, and that's no longer the case. It is also, of course, as you mentioned, when you look at the fiscal deficit, I think that's an increasing concern among investors. I think that is something that they're aware of. We obviously had the Fitch's change in the rating, credit rating. And so I think, supply, demand, these things have all changed dramatically in terms of the dynamics around the Treasury market and the huge amount of supply that we are seeing and the lack of demand that we're now seeing. I mean, we've seen a completely different shift in dynamics, and so it's not a surprise, really, that you would see yields rise.
Marilyn, could you give us some detail on that? I know you and the team have been thinking about this and working on it. We've talked a lot about supply. How have the sources of demand changed in the Treasury market?
So we did have, obviously, a huge source of support from the Fed, and that is no longer the case. Now they're running off their balance sheet. So that was over 50% of support for the Treasury market that's no longer there. Then when you look at pension funds, life insurers, of course, the demand is still there, but I think it's probably slightly less now. We have already seen a big shift in terms of their asset allocation. And you also see, other investors such as, money market funds, and they're obviously supporting it at the front end. But really, when you look at this demand in the belly of the curve or in the long end, when you look at foreign investment demand, for example, as well, the FX hedging costs are now very, very high. So you want to see a shift in the FX hedging costs to really see those investors coming back as well, or a change in the global growth environment. So there are a lot of different factors at play, but the support that was there for the Treasury market is just not there at the moment. And also when we're in this environment where we are seeing a lot of positive data continuing to come out of the US, we've seen a lot of market commentators, reassess their view of the US economy and the trajectory, and many people are no longer, predicting a recession, and they now actually expect the economy to maybe moderate, but remain, relatively robust. And so there's no longer the supply or the demand for the supply when you're looking for a safe haven, because the economy is doing very well, and we're in a very, very different situation than we were 2 or 3 years ago, which was in itself unique and has created many of the factors that now contribute to this environment.
Well, let's talk about things pre-pandemic. You and I have been talking about this stuff for years, and the conversations, Marilyn, you and I used to have was that yields would stay low for longer than people thought they would. That was just the conversation that dominated things for much of the last decade. Have we truly entered this new regime where yields can stay higher for longer than people think they can?
I think yields can stay higher for longer. We've seen a huge shift in the dynamics, obviously, around inflation, which is persistently high. I mean, as you remember, when we came out of COVID, the narrative was that this is all temporary and, inflation would come down. That is not the case. And I think, we will continue to see inflation. I think we will see it moderate, and it will continue to moderate through the rest of this year. But it is going to remain higher for longer. And I think, therefore, we will see the Fed may or may not, raise rates again. But I think when they pause, rates can stay higher for longer. The fact that the economy is also in pretty good shape, the labor market remains very, very tight. I think there are a huge confluence of different factors that mean that rates can actually stay higher for longer, and we are in a different regime to the one that we were in pre-pandemic. I think we've seen a wholesale reevaluation of the environment we're in now and the global dynamics. And we're seeing a lot of factors that contribute to that, including deglobalization, including ongoing geopolitical shifts. So I think there are a lot of different things that do contribute to that, and they're going to continue.
Marilyn Watson at BlackRock. Marilyn, thank you for the update on the Treasury market. Higher for longer, the message from Marilyn. Heard that earlier this morning from the Sovereign Wealth Fund over in Norway. The CEO, Nikolai Tanger, making the same point on a range of issues underpinning that. 22 minutes into the session, equities positive here by 0.1% on the S&P 500 with some sector price action. Here's Abby.
Driving that very small move, a wide variety of sectors. We have most sectors at this point higher, John. 8 out of 11 S&P 500 sectors are higher, led by energy, financials, staples. On On bottom, it's interesting. Communication services down about 0.3%. Meta, Google, and Netflix really weighing. Discretionary and retail on the day. It's very interesting here, John, because we have so many nuances around this. Both of these sectors down ever so slightly, despite the pretty decent gains for both Target and TJX on their respective quarters. It will be interesting to see whether or not that reverses as the day goes on.
Abby, thank you. Coming up next on this program, your trading diary.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
This is Bloomberg.
Attempting to avoid a second day of losses here on the S&P 500, marginally positive on the S&P. About 25 minutes in, we're up here by 0.1%. That's the price action. Let's get to the trading diary. Coming up, Fed minutes, 2 p.m. Eastern time. Then you're going to hear from the President, President Biden, discussing the Inflation Reduction Act from the White House at 2:30 this afternoon. Walmart reporting results ahead of the opening bell tomorrow morning. Plus, we'll get another round of jobless claims on Thursday as well. And finally, Friday, get more earnings for you from Deere and Estee Lauder, plus Eurozone CPI. From New York City, that does it for me. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Got a mixed tape here, a little red, a little green. Coming up, we're going to break down some of those retail earnings target this morning. We got Walmart tomorrow morning. Jen Bartashis, she's at Bloomberg Intelligence. She knows all that stuff. She and Simone Foxman, they're going to sit down with us and talk retail. How fun will that be? Plus, do not fight the Fed. And when you want to talk Fed policy, our top guest, Danielle DiMartino Booth. She's a chief strategist and CEO of QI Research. She's going to be in studio. How good is that? Then we're going to talk to Nathan Dean. He is like the smartest policy guy.
He's the best.
We've got about Washington, D.C. He knows every bill, where it is, where every congressperson is, what the buzz is in D.C. Nathan's going to join us in studio to kind of break down what's happening in D.C. because I have no idea, and I kind of like it that way. But right now, let's kick everything off with the Bloomberg Business Flash. Denise Pellegrini.
Yeah, it's 10:01 on Wall Street. We do check the markets for you all day long at Bloomberg. Paul, stocks, as you mentioned, kind of a Christmas tree kind of thing, red, green. U.S. July industrial production rising more than expected, 1% month on month. The estimate just 0.3%. Target up after earnings. We got those Fed minutes coming. And Greg Peters, co-CEO at PGIM Fixed Income, says the growth story is strong. But he also says higher interest rates are going to make it painful for some.
There's been so many capital structures, whether it's in commercial real estate, whether it's in credit, that have been built on the backs of extremely low interest rates. So as interest rates remain at the higher level here, then a lot of those capital structures really can't withstand that environment.
And Peter's there on the Bloomberg Surveillance podcast. The Dow right now up 0.3%, 109 points higher. The S&P 500 up fractionally 1 point. The Nasdaq, it's down 0.3%, 39 points lower. The yield on the 10-year pretty much holding steady for much of the morning, creeping a little bit higher, 4.2% right now. And the yield on the 2-year at 4.92%. Spot gold up about 0.1%, 19.04 an ounce. NYMEX crude down 0.2% at 80.82 a barrel, getting closer to that 80 level. And Target shares are up about 6%. Big profit gain there, overshadowing the cut to its forecast. Target extending progress in boosting margins, but it also is cutting that forecast, as I mentioned, for the year. And that is a Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. We appreciate it. Red and green on screen, as Denise was just mentioning. But let's see what's happening underneath the hood here. But first, Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio. Guess what? We're also live streaming this stuff on the intraweb. It's a thing the kids call youtube.com. Guys, head over there. You can search Bloomberg Radio, Bloomberg Global Markets. Anyway, that'll get you to us.
By the way, the 10-year yield.
Talk about it.
420, buddy.
Oh, I got what you're saying. I get what you're saying. All right, Bailey Lipschultz, he covers all the markets for us. Bailey, what are you looking at today?
Yeah, seeing some earnings rolling in. Target right now up 5.3%. Really, analysts were expecting lackluster results. So for Target, ticker TGT, biggest rally at one point since March 2022. Now that's size and scope dropped to November 2022, but still up about 6% this morning. Another company trading markedly higher among the best performers in the S&P 500. Progressive July net premiums up 21% year over year, so $5.95 billion versus $4.93 billion last July. Those are your two top performers in the S&P 500. One of the laggards is Agilent Technology. Forecast cut, estimates missed. This is a lab instrument maker, really blaming that lackluster outlook on China weakness. So a lot of moving parts, even though broadly speaking, you have the S&P up less than 1 point this morning.
So what's the consensus here? I mean, year-end forecasts are still below where we're trading at 44.38, right?
Yeah. I mean, you're like when you look at kind of how we've been trading and you look at kind of these expectations, we've seen again, a market where the others had started to catch up. But when you look at the results, I guess you can call them better than feared. But really from Target and Home Depot and some of the other peers, nothing kind of gangbusters to drive sentiment higher. But we are getting to the point here in August, as summer unfortunately rounds to an end, where people are now reassessing what 2024 looks like.
Dude, September's the best month down at the shore. I'm not buying this summer's ending narrative, all right?
Well,
just let you know.
Well, nowadays, I mean, September's probably going to be the nicest month of all summer.
Exactly. Well, the water's warm. The tourists are gone. It's all good. Anyway, so, Bailey, talk to me about the new issue market. Didn't we have a SPAC recently? I mean, what's lining up for September? I mean, people are going to be coming back from the Hamptons, the bankers.
Paul expects the IPO market to be alive and thriving.
Yes, and
to be reborn.
To finish out the year.
I don't know if it will be reborn, but you've got people are pounding the table for ARM. You see some of the reports coming from Bloomberg, Birkenstock, another one, Turo, Instacart.
Those Birkenstock, that's like the shoe thing?
The sandal, Jesus sandals.
They're
yeah.
super. I'll tell you what, wear Birkenstocks for the first 2 weeks, your feet will be killing you, but then you're going to feel glorious.
You're never catching me in Birkenstocks.
After that. That would be my ultimate dream, to see you wearing Birkenstocks. Like, I've already got you in a pickup truck once.
Yeah, you did get me in a pickup truck.
But as you mentioned, Paul, you see a de-SPAC VinFast Auto right now trading at $29. Yesterday, it went up 255% to $37. That's really just a product of being a low float stock. But when you look at the new issuance market, you look at what we're seeing with secondaries. Broadly speaking, the market firming up. The VIX still well below 20. The fundamentals are there. It's just a matter of these companies being willing to press go and investors meeting them halfway on what those valuations should look like.
But we've had some good deals this year. The thing, you know, what was the one that spun out of like J&J or something?
Kenvue.
I mean, there's just like a basic consumer products, you know, reasonable multiple, you know, just ripped, man.
Yeah, it started out pretty strong. I mean, now it's only up 7%. That exchange offer is actually happening this week. So if you have J&J shares, you can actually swap your J&J shares for Kenvue shares. That deadline is by Friday. But when you look at it broadly speaking, if you exclude some of these split-offs and spin-offs, for the last year, you're really driven by the likes of Mobileye, Kenvue, Nextracker, all split-offs or spin-offs. So a lot of the big actual companies raising cash in IPOs were coming from safer companies as they kind of right-size. Your biggest true IPO this year was Acelerin, which is a biotech stock, still up 50%, but that's all based on excitement around the area that it's studying, and that company did only raise $621 million.
You know, we used to, back in the day, we'd have alerts set up. So if any stock moved like 20, 30, 40% in like a 3 or 6 month period, ping, we'd pick up the phone and say, hey man, we'll bid you on, 10 million shares, 8 million shares, at a 6-7% discount and go dump them in the marketplace. You can make a living off of that. I don't see that as much anymore in this market. I think people are just still too spooked by what happened last year in the marketplace.
Yeah, a lot of caution. I mean, if you look at the IPO ETF, ticker IPO, a lot of people will talk about the rally that we've seen since January. But if you step back and look at where it's trading compared to where we were in 2021, it's still down more than 50%. So a lot of people got burned with a lot of these money-losing tech companies at valuations that now, in hindsight, look kind of like a joke.
We have had a lot more IPOs already this year than last year. I like to look at IPO Go and then click on the time series tab.
Yeah.
I'm not saying it's flawed, but you have to kind of know how to operate it, just because if you look at and compare, we're actually down in terms of cash being raised on U.S. exchanges compared to last year.
Okay.
Right. I see.
All right, well, I'll make some phone calls, see if I can get something done here after the close. Bailey Lipschultz, thanks so much for joining us. He covers all the markets for us. The retailers coming in with some numbers here today. Target, TJ Maxx. We got Walmart tomorrow. Let's roundtable this thing with some smart folks. Jen Bartash is senior industry analyst with Bloomberg Intelligence. And Bloomberg News, Jen joins us via the cam from the Princeton office of Bloomberg Intelligence. And then we got Simone Foxman. She is a Bloomberg reporter for Bloomberg Television, joining us here in studio. Jen Bartash, let's start with you. TGT, Target, stock's up over 5%. The market, what is it like here out of the Target results?
Well, when we look at Target, what the market likes is that margin is up, and it's up significantly over last year. At the same time, I think everyone recognizes that it's a difficult operating environment. And so even though Target reduced its full year guidance for sales and for profit, I think that people are encouraged by the way that margins are responding even in that environment.
All right, so Jen, just for our viewers on YouTube, I want to point out that you have what is probably the best quote-unquote office in Bloomberg. It is a kind of a corner office. Now, no one at Bloomberg has offices. We all sit at our desks in kind of the bullpen style, but Jen has got about as close as you can get to a corner office. I just want to point that out.
It's
and
a
that
sweet
is because
setup.
She's been running the Princeton office for decades. I mean, she's basically the leader down there. So we were able to bring her to BI, so that's pretty cool. All right, Simone.
Simone Foxman sits near a window.
She does sit near a window.
I also sit near the great Michael McKee, who's a frequent Bloomberg radio guest. But
exactly.
I once had my own office because I was the only correspondent in the country. So
nice. That's
but
when
anyway,
you're in Qatar.
But you want to hear about retail in the United States.
Yes. So what do you got here on our good friends at TJ Maxx?
Yeah, I mean, beaten a raise. Really, right across the board, raising their outlook for the year, seeing comparable sales 3 to 4%. I mean, the idea value is attracting customers. They're seeing increased traffic across all their major brands, according to the CEO there. Even home goods, that was not expected to do quite so well. Comp sales there were expected to be slightly in the negative, but we saw 4%. Year-on-year rise. So even though consumers are looking away from their homes, they've spent so much time there, they've invested there during the pandemic, and they are moving on, home goods is still able to attract people. So a broadly very positive earnings report for TJX, though I will say shares 3.6% higher, not the 5+ that we're seeing in Target.
All-time high for TJX.
That's
I will
true.
point that
That's
out.
true.
All-time high for the stock.
Well, I mean, are people stepping down? Are we starting to see that, Jen? For a long time we've been hearing guests come in the studio and tell Paul and me that people step down from Target to Walmart. Are they stepping down from Target to TJX?
Well, I think across the board, you're talking about what we consider to be a flight to value. And so regardless of where your household income level lies, people are increasingly seeking value. And that's one of the things that makes TJX such a great opportunity for people, in that there's something always new. They go in, it's treasure hunt. And if you're talking about the Walmarts and the Targets of the world, you're seeing consumers shift into areas where they think there is value. So there are some shoppers who have moved from Target to Walmart, especially when you're talking about essentials, where Walmart's prices are just generally very, very sharp. But we're also seeing people move from Walmart down to dollar stores. So it's really that progression of the flight to value that is really describing the current economic environment and the consumer environment that we're seeing.
And I think when you think about it too, the area we've heard folks across the consumer space be really negative is those middle income consumers who want to cut their discretionary spending. And TJX offers a bit more of that discretionary spend. So instead of going to the top line retailer, you have people going out and saying, I want to do that treasure hunting. I think that is a better use of my wallet than just simply going to a store where I don't have to do that,
Right.
but I'm also going to pay.
And Simone, I noticed, kind of what was unusual for TJ Maxx here is, okay, they beat the quarter, but unlike Target, who was cautious in their outlook, they TJ Maxx boosted their outlook here. So what's kind of the driver there?
Extremely strong commentary saying
Really?
that they're off to an incredible, a very strong start, I believe is word for word in the third quarter. So I think everyone very optimistic there that this flight to value, as Jennifer was talking about, will continue. Even if a recovery to some degree materializes in the way that Target has been, I guess, hoping and praying for on their call.
Jen, what do you hear about the excess savings? I heard someone this morning, I think Carl Riccadonna on Bloomberg Surveillance say that, Carl Riccadonna over at BNP Paribas, saying that at least, there's been a debate about whether or not Americans still have excess savings left. But he says one thing is for sure, that the lower, let's say, 3 quintiles have already blown through it and have nothing left.
Yeah, that's what we're seeing too. And there's growing use of credit card debt, or credit cards, and debt is a little bit on the rise, especially for those quintiles that he was talking about. And so those consumers are really looking for where to spend that money. And I think one of the other things to think about is that the retailers in general still haven't gone back to pre-pandemic days of promotions and the same types of levels of sales and discounts. And so although they're offering value, that type of sales environment or promotional environment hasn't yet come back. Now, that may be on the horizon if things don't change soon. But I think it also supports why we're seeing the popularity of things like TJX. Because people aren't getting those sales at the big box retailers or some of the other retailers at the moment. And so they're looking for where they can find some of those key brands, but at a much lower cost.
Simone, what else are you looking at here in the retail space as we get some of these companies reporting earnings?
Yeah, I mean, tomorrow we have Walmart. That's the big dog there. Yep. I think shares hit an all-time high earlier this week. And so I think expectations are very high that they can benefit from this environment in a similar way to perhaps TJ Maxx is, that consumers are trading down. They're doing more of their spending at Walmart. Walmart Plus growing an increasing number of subscribers that are using its food businesses and that sort of thing. So that'll be an interesting data point to watch. I'm also interested, we heard from Target this morning about the impact of student loan repayments kicking back up.
Right.
Do we hear that from TJ Maxx? They have yet to have their call. Do we hear that from Walmart? We're just trying to get a sense of how much this is actually going to weigh on consumers as we head towards the fall, and then of course head towards the holiday season.
You ever been at TJ Maxx, Paul?
Probably, but
I have to say, I haven't been there in a while, but when I would go, and it's still if I would go today, Jen is right, or I don't know who said that about hunting for, it is an adventure to go in there because there's so much stuff, and you're gonna find like 3 cool polo shirts for $29.99 that you would normally pay $100 for. So
I think that's how you can make sense of it, right?
Yeah.
When I was younger, I loved doing that so much more. And I think if thanks Bloomberg for paying me, but I think if my pennies were tighter, I would worry a little bit more about where each dollar was going, and therefore I would feel like, okay, I've put in the hard work to go and buy this handbag. even though my dimes are tight.
But my point is, it's not
whereas
even hard
Walmart,
work.
Whereas I guess you go to Target, it's
Yeah.
everything's much more laid out for you.
I mean, my
It's
point
easier
is,
to find.
it's actually a great way to spend an hour or two in the city, like going to a Barnes and Noble and just
Oh
hanging
my
out.
God.
You know?
But this is why you come
This
to
is
New
the
York
great
City.
Matt Miller. That is
When I
how
was a
far you've
kid, I used to do that.
How far you've fallen. Jen Bartashes, senior industry analyst of Bloomberg Intelligence, and Simone Foxman from Bloomberg. She's a reporter there, joining us, talking to us about all things retail. Again, Target, some numbers came out this morning before the open. The market likes it. Stock's up more than 5%. TJ Maxx, also some good numbers. Walmart, tomorrow morning before the open. Walmart, it is at an all-time high for the stock price. How about that for our good friends down in Arkansas? We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning.
There you
Yeah,
go.
I'm a big TJ Maxx fan too.
There
Okay,
you
so
go.
we're talking Tesla right now. Tesla is cutting prices in China again for the second time in 3 days. Bloomberg's Kimberly Adams has more.
The company reducing the price of Model S sedans and Model X sport utility vehicles by nearly $10,000. The move coming just 2 days after Tesla marked down the long-range and performance versions of the Model Y SUV and extended an insurance subsidy for the base version of the Model 3 sedan. The cuts are fueling concerns the car maker is reigniting a price war.
And shares of Tesla right now up just a fraction. Target's surprisingly strong profit rebounded in the second quarter. It's overshadowing a cut to its profit outlook for the rest of the year. Bloomberg's Gina Cervetti reports.
The latest results reflect progress in working through bloated inventories that forced steep markdowns a year ago. Target did post a sales decline, and that was the first one in 4 years. Revenue during the latest quarter took an extra hit from the controversy around Target's Pride Month collection of goods.
Now, shares of Target right now up more than 4.5%. And TJX, one of my favorite places, swept past estimates for the second quarter, raised its guidance for the year because customers are looking for cheaper alternatives. CEO Ernie Herrmann said that the numbers were ahead of the company's own expectations. He said clothing and accessories sales were very strong and home sales improved, with home goods posting a 4% comparable sales increase instead of reporting an expected decline. Now, TJX is also the parent of Marshalls. TJX shares right now, they are up about 3.5%. Those are the companies we're following. I'm Lisa Mateo.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 10:21 on Wall Street. We get the markets for you all day long here at Bloomberg. I'm Denise Pellegrini. Stocks, they are higher right now. U.S. July Industrial production rising a more than expected 1% month on month. The estimate was about 0.3%, and Target is up after reporting earnings. The Dow right now up 0.3%, 121 points higher. The S&P 500 up 0.2%, about 10 points. The Nasdaq up fractionally, up 7 points. The yield on the 10-year down just a little bit from the last time I spoke to you guys, 4.19%. Now spot gold, it's up about 0.1%, 19.04 an ounce. Crude oil right now, it is lower, down about 0.2%, 80.84 a barrel. Silver still above that 80 level. Target shares, they're up more than 4%. Big profit gain there, overshadowing the cut to its forecast. Target also extending progress in taming inventory and boosting margins, but warning backlash to Pride Month merchandise hurt sales. Company also cutting its forecast for the year, as I mentioned. Of course, we'll be getting those Fed minutes out this afternoon, Wall Street time. And that is a Bloomberg Business Flash. Paul and Matt, back over to you.
All right, Denise Pellegrini, thank you so much.
Backlash to Pride Month hurt Target sales?
Yeah, it's the same or similar thing to the Bud Light thing.
So people were like, they're celebrating Pride, I'm not going to go in there.
Exactly.
Yeah.
Yeah, so it hurt them for a little bit. It's definitely hurt Bud Light big time in terms of sales and everything like that. So that's a real thing. All right, let's get to it here, kids. Next week, Jackson Hole. I am still searching my inbox for the invite, Matt, and I know it's there. I just can't find it, but I don't know if that's going to be a big deal anyway.
I heard they disinvited a lot of people. Like, remember when the Soho
Why you look at
House
me?
canceled all the bankers' memberships?
Yes.
I think that Jackson Hole did the same thing a couple years ago.
All right, let's bring in Danielle DiMartino Booth. She's the CEO and Chief Strategist at QI Research. She joins us live here in our Bloomberg Interactive Broker Studio and on YouTube, so that's even better. Danielle, I guess the narrative now with our Federal Reserve and with rates is, not how higher they go, but it could be how long are we going to stay here. How are you viewing that part of the narrative?
So I think the higher for longer narrative is something that markets do not want to accept, but we have to bear in mind that Jay Powell started in January of 2022, kind of like Obi-Wan Kenobi. This will happen, this will happen, this will happen. These are not the droids you're looking for. And so he's managed to really extend this narrative. And I think that, if you look at what a lot of people are starting to believe compared to 12 months ago, now they're saying we might not see quantitative tightening stop until the fourth quarter of 2024. That is a form of higher for longer, even if we see rate cuts in 2024.
All right, a very smart listener of ours kind of wrote in and asked about that. The relationship between running off the balance sheet and interest rates. You made a comment the last time you were here about that. What did you mean by that relationship?
So, we are a nation that exists. Liquidity is the lifeblood of the U.S. economy. It's 70% consumption, but so much of business investment, so much of consumption is derived from credit. And when you're pulling liquidity from the system, you end up seeing things like the New York Fed's work that shows that companies anticipate rejections being at the highest levels on record in the next 12 months when it comes to credit card, home loan, auto loans, and what have you. So that is a reflection of a credit crunch, which I've learned is a term that showed up in 1966.
Oh,
it was
okay.
born by two guys from Salomon Brothers created the term. They said a squeeze and a pinch, they might be kind of friendly. A crunch is not. A crunch can break a bone. And that's what we're in the midst of, quietly. And that's what we're seeing with Moody's and Fitch and the warnings that we've got on banks.
I love that.
Yeah.
So what, these two guys at Solomon said, used to be people would say credit squeeze or credit pinch, but that was like too fun.
It was too fun. And that's
crunch.
what happened in 1966. You had banks pull back on lending while the U.S. government had been quantitative tightening, directly influencing that flow of liquidity or not into the system. It's something we see every Friday afternoon after the close in the Fed's H8 document. You're seeing commercial and industrial lending negative.
How much does the Treasury issuance sort of add to that liquidity problem?
Well, so the first 300 billion or so were kind of benign. You saw money move out of the Fed's facility, overnight facility. People were like, "Oh, look at this! I'm going to move it into Treasury bills, money market funds." Where are we going forward? If inflation is as sticky as the inflationists say it's going to be, then if I'm a money market fund, I'm going to say, wait a minute, I'm not going to go into bills. If I think the Fed's going to raise interest rates one more time in 2023, maybe it's September, maybe it's December, then I'll wait and I'll keep my money at the Fed, meaning they're not going to naturally absorb all of this Treasury issuance, keeping that effect benign, and you end up having quantitative tightening join with Treasury bill issuance, and you're having a double pulling of liquidity out of the system.
All right, I consider myself a pretty good reader. The nuns of Blessed Sacrament instilled that in me early age, but I'll tell you what, I am not reading the Fed meeting minutes come out later today.
That's why we have people like Danielle.
That's why we have people like
Well,
Danielle.
I went to Mount Sacred Heart, so we're like in the same, yeah.
Very good. So what will you be looking for in these meeting minutes?
The softer the landing narrative, the more they're going to stick with their higher for longer.
Okay.
So, I mean, and look, minutes can be massaged. Janet Yellen said so in 2008. She said minutes can be like any other tool in the toolbox. It's not like the minutes from a corporate board meeting or something like that. In the 3 weeks that come in between, the Fed can change what actually occurred inside that room. It's kind of like magic. So if they want to nod to retail sales being stronger than what was expected, then you can have a more hawkish tone in these minutes, and that's what I'm anticipating.
What about the difference between Jay Powell's standard line, you know, that we're going to keep rates higher for, I think last time he said for years.
He did.
Yeah. So at the same time, we get a dot plot, which I know is not a forecast from the Fed, but it is each individual member's essentially forecast, right? That showed at least 1 full percentage point of rate cuts next year. How can he say we're going to keep rates at this level for years, and everybody, even, you know, I'm assuming the voters are saying, no, it's going to come down 1%.
So it's kind of like, have you ever heard 1 martini, 2 martini, 3 martinis floor? So he can withstand 1 or 2 dissents and maintain his power base. You start to get to a number like 3 and you start to say, gee, is there a mutiny on the FOMC? So we might see dissent next year from some of the more dovish contingency. He might want to hold out for longer. And that might mean that we see his first real dissent. And we've seen Neil Kashkari, who used to be the most dovish person on planet Earth, become like, you know, we're not finished fighting inflation yet. So he's like very hawkish. So,
and still says we're not done.
Exactly. Yeah. It was just a few days ago.
Our good friends at Goldman Sachs, I guess on Sunday, put out a note saying that they expect a rate cut in the second quarter of next year. Was that just to sell books, or do you think there's something to that?
Talking a book at Goldman? Oh my gosh, I've never heard of such a thing. Look, Goldman Sachs has tremendous influence on the New York Fed. The New York Fed has a permanent vote on the Federal Open Market Committee. This is a known. So I think Goldman is definitely trying to control the narrative, and they've done a very good job of that in the past, of having a very extra large influence on Fed thinking. But Powell's not an academic. Powell was the one who brokered the Treasury scandal at Salomon Brothers with Warren Buffett in 1998 when he was Assistant Treasury, the Secretary. Cool. Powell's not intimidated by bankers. Sorry.
Interesting.
One of the things that you were telling us about Powell around S&P, 3,800 was that he wants to break the Fed put. He wants to destroy the idea that the Fed is going to come to your rescue, Mr. Market, every time the equity indexes fall. Now we're at 4,500. Is that making it harder for him to succeed when the market just continues to rally as they raise?
No, it's making it easier for him. I mean, he's basically shut down the commercial mortgage-backed securities market. So that's one corner of securitization that's vaporized into thin air when in March of 2020, the entire commercial real estate industry was like, hold on, we need to bail out too. But he's actually created price discovery in a market where none existed. There was a building that just sold for 67% off of its prior appraisal in San Francisco a few days ago. So he's slowly killing off lines of speculation into the markets. I think the CLO market is next. So let the stock market be as high as it wants. It gives Powell license to continue depleting liquidity from the system and taking out some of the most speculative forms of credit creation.
Giving him cover, essentially.
Covers the word.
Yeah.
All right, so I mean this in the nicest way possible, Danielle, but you are a data geek of the highest magnitude. What data are you looking at that maybe we're not?
So I follow 2 things very closely. The employee retention credit, it's advertised everywhere by a man
on Bloomberg Radio.
Little white
Bloomberg
hat,
Radio.
Right? I mean, it surpassed 30 billion for the first time in the month of July. So on a 12-month run rate, it's pumping $400 billion into the economy. Very real money. That's about 1.5 percentage points of GDP growth on an annualized basis. We're seeing that manifest in much higher international travel. So it's going to your top quintile of earners, if you will, and that's being actively sold. So I'm paying very close attention to active fiscal stimulus. $400 billion a year is not nothing. And dailyjobcuts.com. We've gone from
daily job
5
cuts
business
dot com.
closings to 9 from the summer months after the debt ceiling was resolved into August. The founder of the website said he's seeing a massive increase in companies just closing up shop in August, saying, I don't see over the horizon the holiday season, holiday shopping season saving me. So I'm paying really close attention to Main Street as well.
All right, very good. Danielle DiMartino.
Always good
Booth.
to watch the fiscal side, you know,
Always
because
good.
not a lot of Fed geeks do.
No,
Pay
they-
close enough attention to the
It's
fiscal
highly
side.
relevant.
It's highly relevant. Danielle DiMartino Booth, CEO and Chief Strategist at QI Research, joining us live here in our Bloomberg Interactive Broker Studio, which is always a treat. We appreciate that. Looking at the markets right here, still kind of red and green on the screen. The S&P is kind of unched up 0.1 of 1%. The Dow up about 0.3 of 1%. 35,000 for your Dow Jones Industrials, and the NASDAQ off just a little bit. Again, the earnings today and tomorrow, it's all about the retailers' target. Some good numbers today. We'll get Walmart before the open tomorrow morning. With our news in Washington, D.C. is Amy Mars. Very good.
All right, thank you, Paul. Legal experts are offering their predictions for former President Trump's latest criminal case concerning Georgia's election in 2020. Bloomberg's Nancy Lyons with the latest.
Ty Cobb served as White House counsel during the Trump years. He tells Bloomberg this is a complex case.
There's a real possibility it never gets tried, or it doesn't get tried for 5 years.
Former Assistant U.S. Attorney for the Southern District of New York, Jim Zion, believes Fulton County DA Fonnie Willis is up to the task.
It might take some time before they can pick a jury. It might take some time for her to get all this evidence in. But I think that the case is going to proceed, and I think she'll try to prosecute the case expeditiously.
In Washington, Nancy Lyons, Bloomberg Radio.
President Biden says he and the First Lady will be visiting Hawaii soon.
Biden has been catching some criticism for not being very visible. He says he's been in touch with Governor Josh Green multiple times, and the work is being done.
Almost 500 federal personnel have been deployed to Maui to help communities and survivors get back on their feet. FEMA, search and rescue teams are sifting through the ashes in that 5-mile area.
Authorities are asking relatives of missing people to give DNA samples in hopes of matching them up. In San Francisco, I'm Ed Baxter, Bloomberg Radio.
And the death toll in Hawaii is now at least 106. Negotiators for striking Hollywood writers and the studios sat down to talk, and one source tells Deadline that meeting ended with mixed results. The Writers Guild of America is said to have presented a counter to the Alliance of Motion Picture and Television Producers counter-proposal from last week. Still, no word on any future talks or proposals. The writers have been on strike since May 2nd. Movie and TV actors went on strike July 14th. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 10:40 on Wall Street. We check the markets for you all day long at Bloomberg. I'm Denise Pellegrini. Stocks right now are back to being mixed again. We did have some strong eco data. U.S. July industrial production rising more than expected, 1% target up after earnings. And of course, we'll get that Fed minutes report coming out later today. And Stuart Kaiser, he's head of U.S. equity trading strategy at Citi. Well, he says, there's a reason, though, why we could see volatility for stocks on top of rising interest rates.
July was the lowest realized volatility month that we've seen since December of 2019. So you get into August, you get a little bit of a blip, and it feels, I think, a little more painful. But yeah, I think one of the things we were a little bit worried about is a lot of folks were very defensive in hedging earlier in the year. That hedging did not work out. It cost a lot of money in terms of premium paid. The market's probably less well hedged today, than it was probably 3 months ago. So if we do get some losses, the market is going to be a little more surprised by it, or probably a little more disrupted by it than it might have been earlier this year.
Yeah, you heard it here on Bloomberg Markets. People are less hedged today than they were 3 months ago, according to Kaiser with us here on the Bloomberg Surveillance Podcast. The Dow right now up 0.2%, 87 points higher. The S&P 500 up 0.1%, 4 points higher. The NASDAQ down just about 0.1%, down about 12 points. The yield on the 10-year right now, 4.1934% now. Spot gold, it is up about 0.1%, 19.04 an ounce. Crude oil right now, it is lower down about 0.3%. We got that hothead on the terminal just a couple of minutes ago. Crude oil inventories falling 5.96 million barrels, according to the EIA. Target shares, they are higher, big profit gain. They're overshadowing its cut to its forecast. Target extending programs and taming inventory as well, and it's also talking about how it's boosted its margins. And that, guys, is your Bloomberg Business Flash.
All right, Denise, thanks so much. Denise Pellegrini there with the Bloomberg Business Flash. Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're also on YouTube. Just head over to youtube.com and search for Bloomberg Global Markets or Bloomberg Radio, however it works for you, and you'll get the video feed. All right, against my better judgment, I'm told we got to talk about Washington and politics and all that stuff that happens, the making of the sausage. And if we're going to do that, we're going to go to our ace, and that is Nathan Dean. He's a senior policy analyst, U.S. Latin America for Bloomberg Intelligence. Bloomberg Intelligence, we got people who just do everything, and we got a guy who is Mr. Washington, D.C., and that's Nathan Dean. He joined us live here in our Bloomberg Interactive Broker Studio. Nathan, where I want to start is kind of with President Biden last week, seemingly getting a little tougher with China, but it seems like he kind of pulled some punches there. Talk to us about what Biden did via, I think, executive order last week with China and kind of what it means.
Yeah, exactly. So President Biden put out an executive order essentially directing Treasury to limit or prohibit U.S. investments, so primarily private equity, venture capital fund investment into China in certain sectors like quantum computing, AI, semiconductors. Now, this was a much narrower order than what had previously been anticipated, so I think the markets were actually kind of happy with that. We don't think there's going to be that much of an impact here. I think if you look at the private equity firms today, the big ones, they're about 2% below in terms of total assets with exposure to China. So this is really just a symbolism executive order. Now, the Treasury has to implement it, so things could change. And with anything in the U.S.-China relations, Biden can always pull the plug if it suits his will.
You did have at the end of last month, the House Select Committee on the Chinese Communist Party. Uh-oh. Is that really the name? The House Select Committee on the Chinese.
Yep.
It's lucky they threw the word communist in there, so we know how they feel about them, right? That's a little bit loaded. They allege that BlackRock is investing in Chinese companies acting against U.S. interests. Now, I'm guessing this is a Republican-controlled committee. Obviously, those guys don't like Larry Fink. He's like the new George Soros for a lot on the right. But we had a story by Scylla Brush out yesterday that said BlackRock, MSCI, and other firms are bracing for tighter oversight. Is that talk on Capitol Hill going after these big Wall Street fund managers?
Absolutely. I mean, and to your point, it's actually a bipartisan committee because being seen tough on China is good politics no matter who you are. So, when President Biden put out his order, we saw a statement from that committee from both parties essentially saying that this could have gone farther and they wished it had gone further. Now, the question about BlackRock and the other firms is what is considered oversight and what is actually going to happen. Now, that committee cannot write legislation. They need the other committees to do that. And with a Republican House, a Democratic Senate, and a president who also has to stare Xi Jinping in the face at certain events, I'm not sure there's actually going to be actionable concern for those firms. So it's mostly headline risk. Just always keep in mind that when it comes to China, Congress loves to be tough, but it's the White House that actually pulls things back and moderates it.
Well, the White House, Biden last week said that the Communist Party are bad folks. Right? He said the Belt and Road Initiative, he called that the Debt and Noose Initiative.
Well, there's a difference between calling somebody bad folks and actually creating a trade deal or, sanctions and so forth that actually, changes what we here in New York City are trading on.
All right, you're down in D.C., better or worse. You're in the swamp. You're part of it, actually, quite frankly. Let's be honest. What is the feeling in D.C. about China? How worried should the world be about U.S. and China? What's the feeling in D.C.?
So, there was this thought of, will we get into a war over Taiwan? And we have a national security analyst who has been writing about this on the Terminal. The general thought on Washington is we're still years away. Okay. That this is not something that you can anticipate will happen in the next few years. And when it comes to how do you approach this in terms of a market perspective, it's sort of something that, like, everything that we've seen before has happened in the past. There's really, there's not been a lot of actions from China that haven't been actually done 10 years ago, 15 years ago, so forth. So, we're just still in this wait and see mode. I think if you talk to most Congress folks, they're just rather happy to blast China and get the good politics from it.
I'm pretty excited because Ohio looks like it's going to be the next state to legalize marijuana. And this is something that we're following very closely, right? Of course. For recreational use, that would be the 24th state. Now, it's still federally illegal. And Nathan, you follow closely the Safe Banking Act, which I think is actually moving slowly enough that following it closely is no problem, right? But the cool thing about Ohio is Sherrod Brown is our senator, the senator from the great state of Ohio, and he's also the chairman of the Senate Banking Committee. So if it's legal in his home state, does he have then more, cover to push for broader legalization federally?
Yeah, if Sherrod Brown wanted this thing done, he could have it done today. There's nothing that is prohibiting the Safe Banking Act other than Sherrod Brown and a couple of other senior senators on both parties. When it comes to the Safe Banking Act, the problem they have or the bill has, is timing and the procedures. Now, there's a lot of people hoping that the Safe Banking Act goes as part of the funding bill that is going to come up in September. Now, that's most likely going to end in a government shutdown, and Speaker McCarthy was talking about having a quick continuing resolution into December. That means the Safe Banking Act probably won't be assigned to that. Then you get into December. There's only 8 days where Congress is meeting per month, October, November, December, and then we're in election season. So I'm not sure the Safe Banking Act actually has a vehicle to get to passage unless Sherrod Brown steps up and says, I want this done today. And I have not seen anything that says that he's interested. He's been flirting a lot of, I like this, but also this and so forth. And there's a whole issue right now on Senator Jack Reed has been trying to negotiate with the Republicans on, and they haven't made any headway on that.
What are you focusing on down there in D.C., legislation-wise or otherwise, that Matt and I are totally ignorant of?
Well, the shutdown, for one.
Yeah, that's big.
Well, the shutdown is actually, we dust off our note every 2 years when this comes out. And when it comes to the shutdown, markets get scared within the first 2 days. And then once they realize the economic impact of a short-term shutdown isn't all that great, markets actually go up. If you look at the 30-day shutdown that happened under the President Trump administration, the markets actually were pretty much fine with it. And if you're invested in the contractors, well, most contractors, at least the big ones, have 18-month, 2-year, 2.5-year contracts. So the only people that are harmed are the contractors that work in Washington, D.C., and those of us who can't take our kids to the zoo.
See? Yeah. With Nathan Dean, you can go from China to the U.S. government shutdown to weed.
To the zoo,
all in one conversation. That's why we like this guy, Nathan Dean. He's a senior policy analyst for Bloomberg Intelligence.
Notice I didn't even bring up salt.
We didn't even bring up salt. Is salt happening?
Which is
salt
fine.
happening? Yes, no.
No.
See, boom, there you go. See, that's all you need. So Nathan's part of this team down in D.C. How many do we have down there in D.C. that are kind of doing all this policy stuff? 8. So you got 8 people in D.C. for Bloomberg Intelligence that just work on what's happening in the government and how it could impact financial markets and investors. How cool is that? This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it. Goldman Sachs stock has gained nearly 50% under the tenure of its CEO, David Solomon. But after a couple of mixed quarters, grumbling is starting to get a little bit louder about the man at top. Bloomberg's Sri Natarajan is following this.
It has become an increasingly frequent occurrence at Goldman, and it is putting a lot of senior executives in a lot of awkward places. When you have a number of people that are out there, they're hearing from their clients, they're hearing from companies, they're hearing from anyone else in the industry who cares about Goldman Sachs and who follows Wall Street closely, it just happens to sit around you all the time. How does it come to head is when you have a situation where this group of very influential executives inside the firm continue making the noise and say, we are ready, we are there for anyone but David.
Now, Natarajan says it's putting more pressure on Solomon's number two, John Waldron, to either win over those disgruntled executives or be seen as a David Solomon clone. Now, shares of Goldman right now down about 0.5%. Well, the threat of an auto worker strike continues to loom. Bloomberg's Courtney Donahoe has more.
The United Auto Workers will vote next week on whether to authorize strikes against the big three automakers. Union President Shawn Fain says talks with General Motors, Ford, and Chrysler maker Stellantis are moving too slow. The contract expires on September 14th.
Now, Fain also says the group has been negotiating with the big three automakers for more than 30 days, and they really have yet to discuss economic terms. Now, checking in with shares of all of them right now, they are all down. We have General Motors down about 1%, Ford down a fraction, same for Stellantis right now. Those are the company stories we're following this hour. We'll have much more Bloomberg Markets in just a bit. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Alrighty then. Matt Miller, Paul Sweeney here in the Bloomberg Interactive Brokers studio. Kind of red and green on the screen. I'm going to call out the Dow because that's kind of the only thing moving up 0.3%, 112 points, 35,058 for your Dow Jones Industrials. WTI crude oil absolutely unched on the day, sitting right around $81 per barrel. Nothing happening in the world of crypto. We don't talk about crypto nearly as much as we used to. Bitcoin sitting at 29,100.
Yeah, because it's there all the time. You know, no volatility.
Yeah,
for at least 2 months, it's been at 30,000, right?
Yeah, absolutely. So it used to be a kind of a fun thing to chat about, but not so much. Let's head down to Washington, D.C. right now. We'll get world and national news from Amy Morris.
All right, thank you, Paul. Former Trump Chief of Staff Mark Meadows is trying to have the charges against him in the Georgia indictment moved to a federal court so he can ask the judge to dismiss it. Former White House special counsel during the Trump administration, Ty Cobb, talks about that strategy with Bloomberg's Sound On with Joe Matthew.
To move it to federal court, but it's hard to see importuning the governor of Georgia to come up with 11,780 votes under color of law, as is required in statute. So I do think the odds are that it stays in state court.
Former White House special counsel Ty Cobb adds he also does not think the case will be tried at all, or it won't be tried for several years. The slow process of rebuilding Maui is getting underway bit by bit. The road leading to West Maui is now open, but downtown Lahaina is still off limits. Maui County Mayor Richard Bisson says there's a process for reopening the town, and it's going to happen in phases.
Once we've determined that to be a safe zone, and the EPA has gone through there, and they have removed all the hazardous and toxic material out of Hawaii. Then we can begin the debris cleanup, which is a different phase, and then at some point allow landowners and homeowners and business owners to return to that location.
The death toll in Maui is now at least 106. The search and recovery process continues. Madonna is announcing the rescheduled dates for her celebration tour. You might recall the pop icon was rushed to the hospital back in June for a serious bacterial infection. The U.S. leg of the tour now set to kick off on December 13th in Brooklyn, New York. Today is also Madonna's 65th birthday. She's 65. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Matt and Paul.
All right, Amy Morris, thank you so much. We appreciate it. My Irish ancestry coming into news today. The Bank of Ireland said it fixed a technical issue that allowed customers to take funds above their normal limits.
Yeah, so a glitch with the lender's online app allowed people who had no money, $0 in their account, to transfer up to $546. It's that number because it's actually 500 pounds. 500 euros into a Revolut account. That's like kind of an alternative banking online bank that people use over in Europe. So if you had no money, you could put 500 euros into a Revolut account. That led to queues forming at cash machines on Tuesday as people subsequently withdrew the funds from their Revolut accounts. So I guess word spread quickly.
Around the pub.
Yeah, exactly. And they quickly made the transfers, went over to Revolut, and withdrew the cash. So
that is funny. That's like that is probably not good for our friends at the Bank of Ireland, but it's funny to see how the word spreads. I could just see a bunch of old guys sitting around in a pub, and I just went and moved 500 pounds or euros or whatever they're doing
from
over
an
there.
empty account.
Yes,
exactly. and I'm sure it's not horrible advertising for Revolut, right? And they have 1.9 million customers in Ireland, or they did last year. That's more than a third of the population. And I guess the other 2/3 probably joined over the last couple of weeks when they figured this out.
Exactly. All right, we'll keep an eye on that. So good news, fun news out of the Bank of Ireland, except if you are at the Bank of Ireland here. All right, looking at this market here, just above S&P 500 up 0.2%. The Dow about 0.3%.
The 10-year yield is 1973. I like that.
Yeah, that's 1973 was a good year for
That's a great year for me.
Yeah,
I was made and brought to life that year.
Puts and calls in the marketplace, that's what we call it. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to talk about the bond market, what's happening there, and what is it telling us about future interest rates. Natalie Trevithek, head of investment-grade credit strategy at Payden and Regal, will join us. And then we're going to learn about preferred stock, whether we want to or not. Doug Baker's going to come pitch us. He's a portfolio manager and head of preferred securities sector team at Nuveen. He's a big bull on that part of the market. Matthew Palazzola, we only talk to him when there's disasters and bad things happening. That's because he's an insurance analyst, and he's going to join us to give us kind of the latest economic impact from that disaster that we're unfortunately observing in Hawaii. So he'll be joining us. But first, we're going to kick it all off with Denise Pellegrini.
Hey there, Paul. And it is 11:01 on Wall Street. We check the markets for you all day long at Bloomberg. Stocks right now, they are mixed. We did that July industrial production. It was stronger than expected month on month. And we'll have those Fed minutes, of course, coming out later today. And Greg Peters, he is co-CEO at PGIM Fixed Income. And while he says higher interest rates are actually a sign of strength, right? But he does say, in addition to that, we are going to feel some pain.
We're in this stronger growth environment. But at the same time, we will see above trend default and distress activity as a lot of these companies really just are unable to, be a going concern with a higher rate environment.
And Peter's with us there on the Bloomberg Surveillance Podcast. The Dow right now, it is up about 0.3%, 123 points higher. The S&P 500 up about 0.2%, 8 points higher. The NASDAQ, though, down about 0.1%, down about 14 points. The yield on the 10-year right now, 4.2%. NYMEX crude, it is lower, down by 0.2%. $80.86 now cents a barrel. It was even just a little bit lower, but we got that word that crude oil inventories fell 5.96 million barrels, according to the EIA. That gave it a little bit of a boost off its lows, though still lower. COMEX gold, it is slightly higher, up about 0.1%, 1904 an ounce. Japan's yen weakened to 145.90 level earlier today. That, you remember, is a level that triggered intervention back in September. It's higher now, but we'll see. And Target shares up a little under 4%, big profit gain there. And that is overshadowing the cut it made to its forecast, which usually doesn't go over well, but today that doesn't seem to matter to investors, guys. And that's a Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in the Bloomberg Interactive Broker Studio. We're also live on YouTube. Just head over there and search Bloomberg Global News or Bloomberg Radio, and that'll get you to us. Matt, the room just brightens up dramatically when Jess Metten comes in. I mean,
yes,
a permanent smile.
We like
She's
her.
always got good.
Also, it's not just from her to us, it's
Right.
from us to her.
That's right. That's right. And she's
all these compliments.
Exactly.
Blushing.
Well, I mean, you bring it every day. But I'm looking at these markets here, Jess. You cover all the
I
markets.
feel like the
for
market's
Bloomberg.
brightened up as well. We got a lot better breadth, right? We have 298 stocks up, 203 down on the S&P.
There we go.
You know, we were half and half in terms of the industry groups leading and losing, and now we have 7 up and 4 down. So
I should have worn green today.
Yes,
starting to look better and better, Jess.
You're bucking the trend here. So, Jess, what do you got for us today?
Well, heading into this week, I did a weekend story last weekend with the great Elena Popina. We were taking a look at, obviously, the retailers that were reporting this week. And we've talked so much about how we're already through the most of earnings season with more than 90% of the market cap of the S&P 500 reporting. But something that I had noticed, if you look back since late May, and particularly at the XRT, so the ETF that's tracking the retail shares in the S&P 500, that's up about 16% in that span, and that's more than double the S&P 500. The S&P 500's up about 6% in that. So when you're looking at retailers, they were quietly outperforming the broader market over the summer leading into these reports. So a lot of it, especially when you think about, we did hear from Target this morning, and they had actually cut their annual outlook a few months ago. So the big thing was coming in and seeing how they were going to deliver, as well as other retailers today. They did lower its full year sales and profit expectations, but still, when you're looking at what it's reporting for its gross margins, those actually topped average analyst estimates. So you are seeing that stock supported this morning, and that is ticker symbol TGT.
It is important to note that Target has done horribly this year.
Exactly. So
I mean, they're down 13%
if you look
year to
at
date. Yeah.
basically in that time span from late May to now, Target isn't the one that's helping lift the XRT. If you look at Walmart, that stock is up 8% in that span. You look at Target, it's down about 1% in that span, and even lower for the year. So even though it's up about 3.5% today, that would be its best day since January 6th. Still, that is one of those companies, and especially because this year, it's, along with a few other retailers, is having those issues when you are looking at what's happening with the discretionary sort of shift in types of spending, and their customers spending less on some of the trendy clothes that it has. So it's had a bit more issues than some of its other counterparts.
If you look at Target over the last 5 years,
right.
They had an amazing pandemic.
They did.
The lockdown was great for them.
They were.
Right? Much better than Walmart.
Yeah.
But Walmart just kind of...
that was.
I don't know why. The Target stock doubled, tripled, and a half. So up 3.5 times from basically the start of the pandemic in 2020 to near the end of 2021. And then it just came crashing down last year and also hasn't done well this year. So.
No.
Meanwhile, Walmart has kind of slow and steadily risen, and it's up over the last 5 years about 76%.
Right.
Target's up 77% over the last 5 years.
Yeah.
Look at that.
So round trip for Target.
Right, and Target had been in the discretionary sector but got moved to staples in the spring. So it's because of its grocery sales. So now Target, as well as Walmart and the dollar stores, Dollar Tree, Dollar General, are actually in the staples sector now. But Target at the time during the pandemic was really benefiting from obviously the discretionary type of spending in what it offered to its customers. But Walmart in particular, especially its grocery sales, those have been part of the reason what's really held up its stock this year, as well as obviously when you're thinking about the types of retailers and their clients, a little bit different there. And especially when you think also with Macy's. Macy's had been a company that had obviously been able to weather the inventory issues a little bit better than other companies, but we still have Walmart actually reports tomorrow. So that'll be a big thing. And Bloomberg Intelligence is actually thinking that if you're looking at its second quarter sales, those most likely slowed to 4% from an average of about 8% in the preceding 4 periods. And then they're also looking at same-store sales rising, though, when you're looking at what's happening with basically its core business and consumers still thinking about, when you're thinking of the food sales, when we're talking about grocery in that business, they still think that that's going to accelerate. But that's going to be obviously, when you're thinking about the biggest retailer, Walmart, that's going to be all eyes on that company tomorrow.
I'm just looking at the rich go and how many Waltons are in there. And the Walmart stock hitting an all-time high today. It's just amazing. You put up the chart since the company went public, and it's just a straight shot.
I also want to mention, sorry, Paul, for cutting you off.
No, I just like looking at the rich go kind of function.
So today is August 16th.
Yep.
Last year, that's when the S&P 500 had peaked out intraday at 43.25. And so that's when that counter trend rally from last summer had fizzled out. The week before, obviously, when we have Jackson Hole, we will have that next week. But if you look at that span between when the S&P 500 had peaked then to now, the S&P 500 is up about 2.5% since then. Obviously, when you look on a year-to-date basis, up about 17% and well off more than a quarter up from the October lows. But when you're looking from a year ago to now, up about 2.5% for the S&P 500.
All right. It's good to be a Walton, I guess, right? I mean, and all the little Waltons running around. And
right now, it's good to be a Pham Nhat Vuong.
A what?
Pham Nhat Vuong.
Who's that?
The guy who founded VinFast Auto took it public via SPAC, and all of a sudden, overnight, he's worth an extra $30 billion.
Good for him. Good for him. All right, Jess, thanks so much for joining us. Jess Metten, Bloomberg equities reporter for Bloomberg News. All right, let's get to our next guest, Natalie Trevithick, head of investment grade credit strategy at Payden & Regal. And Natalie, before we get into it, somebody just whispered into my ear, you've completed 13 Ironman triathlons.
13?
What?
Well, actually 16. I did the World Championships last October.
I mean, why?
It makes work seem not so bad. I come into the office, there's air conditioning, I get to sit down, I'm not exercising for like 13 hours.
All right, so what's the best triathlon, Ironman triathlon you've ever competed in? What's your favorite?
Ironman Arizona, that was my fastest time. It's a very flat course.
All right.
But was it your favorite? I mean, is the event fun other than the grueling 13 hours of exercise?
It's great once it's over.
It's great once it's over. All right, I just don't understand these people. Let's
That's
go to
awesome.
something
That's
I
awesome.
kind of understand. What's the bond market telling you, Natalie, here? I mean, it just seems like the Federal Reserve here is, the discussion's kind of migrated from how high the Federal Reserve will go to, I guess, how long the Federal Reserve will stay at these levels. What's the bond market telling you?
The bond market's telling us that it is going to stay higher for longer. Corporate yields just hit their highest level since last October at 5.75%. So while it may not be good for some of the companies that need to come to the debt markets to fund themselves, it's actually not bad for investors to be getting close to 6% in investment-grade corporate bonds.
So what do you expect in terms of like the 10-year yield? There was a great debate between, I think, Bill Dudley on one side and Morgan Stanley on the other. Are we looking at continued selling? Will yields keep going higher, or do you think yields are going to come back down?
I think they're ultimately going to come back down a bit, but they could test that 450 level. So I wouldn't be surprised to see them shoot up there. But we have seen the bulk of the rise in interest rates, I think, so far. So investors should be thinking about getting a little bit defensive in rates now by getting a little longer duration.
So have you taken, you being paid in real, have you guys taken the, thank you, Sebastian. Have you taken the recession call off the table?
It's a very low probability right now. We think a soft landing is most likely and maybe even no landing.
No landing? They got to land a plane somewhere.
And the no landing could be trickier because that's the higher for longer. So that could be a little bit more troubling. Personally, I'd kind of like to get this recession here and over with so we can move on. But we're like just in this state of uncertainty here.
But it does seem like a lot more people think growth could reaccelerate, inflation could reaccelerate. And what happens then? Does the Fed have to raise rates again?
The Fed could raise rates one more time, but again, we're close to the end. But they could keep them higher for longer. But that's also good news because if they don't have to cut, that means the economy is going along fine and employment's still healthy. So it's not really terrible for the markets.
So real rates are what? I mean, Tom Keene has been watching real rates forever, but the Fed started bringing them up, I guess, this year as well. Right now, we're looking at, I think, 1.8, 1.9% on the 10-year. Does that continue to climb?
Yeah, I think we're close to the top there. It's kind of where fair value is on the 10-year historically of around 4% with roughly 2% real rates and 2% extra. But that 1.8, 1.9 is we're getting close to fair value on real rates. That means the market's starting to accept that we're going to have this prolonged period of higher inflation and non-zero rates any longer.
All right, the 2-year Treasury, 4.93%. You know, after the year we all had last year, whether you got creamed in equities or fixed income, sitting there at 4.93% for a couple years, that doesn't seem like the worst deal in the world. Is that where I should go?
She wants to go further out, right? She said, I mean, the 20 years is probably better
nice
for Natalie.
and safe here.
Yeah, because you then have reinvestment risk, right?
All right, tell me what I need to do, Natalie.
Yeah, exactly. You do have that reinvestment risk, but we are seeing a lot of investors buy further out the curve to lock in those longer interest rates for longer, particularly in the corporate market. What's interesting there is whether you're buying like a 2-year corporate or a 30-year corporate, you're getting roughly that same yield of 5.7% currently. And you are seeing that favoritism for longer duration bonds, but also companies aren't wanting to lock in those rates for longer. So they're issuing shorter in the curve.
I wonder about, Denise Pellegrini was asking earlier about the relationship between keeping rates higher for longer and also running off the balance sheet. Both kind of doing the same thing, right? But we've had a lot of people, well, specifically Neil Grossman, complaining that the Fed isn't running the balance sheet off quickly enough. What do you think about, QT versus raising rates or how they work together?
Yeah, I think the raising rates is definitely the more effective approach. So they have been a little bit slow in their QT. But I think the more blunt tool is just going to be to continue to raise rates or keep them higher for longer. But we're starting to see some cracks in the system here. So spreads had reached their tights a few weeks ago, but they're starting to give back a little. There are some cracks in the system, and there's still that delayed reaction to the Fed's hikes.
Do you think the QT is going to continue? I mean, are they going to actually wind down the balance sheet from wherever we stand? I think like $8 trillion right now.
They're going to slowly do it, but they probably aren't going to get back to where they were before all of this QE took place.
All right. So as head of investment grade credit strategy, Natalie, do you kind of get to the level of, are there some sectors you like right here